In this masterclass, I will tell you everything I know about investing and trading. No matter if you're interested in stocks, Forex, commodities, or something else, in this masterclass you will find everything you need to know in order to make money on financial markets. As you can see, Forecaster is a very clean software, is a very simple software, because the aim of the software is to help you understand the market and help you save time in your analysis. And actually, as you can see from the interface, it's it was developed by as Google is. Okay, if you go to Google, as you can see, you can find you can find the search bar here, and if you go up here in the page, you can find all the tools, all the app from your Google account. If you go to the Forecaster, you can find exactly the same page, because you can find the search bar, and if you go here on the page, up right in the page, you can find all the tools. Okay, so this architecture, let's say, is very simple, and it was designed in order to use the software in two specific ways. First of all, you can use the Forecaster terminal in order to analyze a specific instrument, okay? And of course, you can go directly to the search bar and you can search the instrument, the financial instrument. Could be an index, could be a stocks, could be a commodity, could be a Forex. You can search for everything, or you can get ideas from the forecaster, and to get ideas you can go through the tools you have in your account. Okay, so these are the two main ways you can use the forecaster terminal. So today we can start using the old way, the forecaster terminal, let's say, and we can start, for example, with analyzing an index. Okay, let's go, for example, to the S&P 500. Okay, very simple. As you can see, you have different layers inside the forecaster terminal. You can find, for example, the overview, you can find the seasonality, you can find the overbought, oversold, you can find the quote report, and you can find the ranking layer. Okay, why we have so many layers for every instrument you find in the forecaster terminal? Very simple, because on every layer you can find a different approach to analyze the specific instrument you are watching to. So for example, for the S&P 500, you can find the seasonality, you can find the overbought and oversold, where you can find a more statistical mathematical approach. You can find the quote report. Okay, quote report is a very nice style of analysis for the ones connected that doesn't know what quote report is. Very simple. If you go to the cftc.gov website, which is the Commodity and Future and Trading Commission, every week this commission publish a special report. The name is Commitments of Traders. Here is the name. And this is a special report they publish every week, where they tell us where they tell us exactly if asset managers, leveraged fund, and all the other categories of the markets are long or short on a specific future. Okay, and this is why, for example, the quote report layer, you can find it only on financial instrument where the futures are available. Okay, And this is why, for example, if you go on the NVIDIA page, of course, you can find the seasonality. Of course, you can find the overbought and oversold. You can find the fundamentals. You can find the political page with all the trades from the United States politician. But of course, you cannot find the COT report because NVIDIA is not a listed future. And so we do not have a COT report from for NVIDIA. Okay? So, as I told you, for every financial instrument available on the Forecaster terminal, you can find different layer because thanks to this different layer, you can do a different kind of analysis. The goal of the Forecaster is to give you in the same tool different approaches in order for you to have a complete idea for a specific instrument. Of course, all the data inside the forecaster are updated. We do not have at the moment real-time prices for instrument prices, but of course, for example, for the COT report, when they publish report, we have a real-time update inside the forecaster. Perfect, very clear. So this is very important. We have two different approach in using the forecaster. You can go directly to a specific instrument. If you would like to analyze a specific instrument, you can go directly to this instrument and you can analyze with different approaches, with different glasses, let's say, okay? Or if you need investment or trading ideas, you can go and use all the tools available inside the forecaster in order to get ideas. Okay, so these are the two streets you can you can you can go on when you start to use the forecaster. You can start with the search bar, or you can start with all the tools. Today we start with the search bar. So for example, let's imagine we would like to analyze the S&P 500, okay? Very simple. We have an overview page where very easily we can find all the performance for the last one month, 6 months, this year, 1 year, 3 years, 5 years, 10 years, 20 years, and all history, okay? You have the performance divided year by years. And what is very nice and very interesting is that directly on the chart of every indexes and of course every stocks, you can directly plot something like sales, net income, the price earning, and the price earning weighted. You have to know that all the time you hear an analyst talking about the price earning for the entire index, he use a not averaged, a not weighted version of the price earning. It means, for example, at the moment, the price earning every analyst across the globe use is a price earnings, which at the moment is 24.7, which is not weighted. What does it mean? It means that in this calculation, the weight for NVIDIA is the same weight for every other stocks inside the S&P 500. And this is something really stupid. And this is why, in my opinion, because it doesn't make sense. Okay. And this is why we decided to have also the price earning weighted version. Okay. Where, for example, NVIDIA weight for is capitalization. Microsoft Microsoft PE wait for its capitalization, okay? And of course, this is why, for example, I don't use the price earning a lot because it's a metric that I really don't like. What I use is the net income because, as you can see, especially if you go in the past, something really amazing, it's directly in front of our eyes, okay? As you can see, the entire stock market, but of course we will see some example also with stocks, goes up when the net income goes up. Stock market goes down when the net income goes down. And this is a rule that works for every market all across the globe. Okay, and this is something very important. This is why we decided to have this metric directly on the chart. Okay, because for example, at the moment, something very interesting we can see directly on the chart is this, guys. At the moment, the net income for all the components of the S&P 500 is more than $2 trillion. And as you can see, compared to the last year, the net income is rising, okay? Is going up. And this is something very interesting because at the moment, even if Mr. Trump, the new United States president, is doing something crazy on the market with his tariff and with everything else, at the moment, the components for the S&P 500 are doing very good, net income speaking, okay? So this is something really amazing to have directly on the chart because especially with the single stocks, you can understand if a company, for example, is going down, okay, on the market, but at the same time, the results are really nice. And during our webinars, we had many example of company that for many reasons they were going down in the stock market, but at the same time, the results were really nice, okay? And this is exactly what is happening right now with the market. The numbers are great because, as you can see, never in history results as so good like they are right now, but at the same time, we had in the last weeks prices tumbling, okay? Perfect. Okay. So this is the first layer. And of course, you can have an idea of how it's going the market. The next one is seasonality. And this is one of the most important layer inside the forecaster. It was also the first layer we had inside the forecaster when 2 years ago we started the forecaster. This was the only layer we had at the beginning, and this is something really amazing because the seasonality is a very powerful tool. Okay, as you can see, by default, you have 3 and 5 year seasonality, but of course you can add all the other seasonality and you can go until 30-year seasonality. In general, just to be clear with you, I never use more than 15-year seasonality because more than 15 years ago, markets were really different from today. Okay. Anyway, it's up to you. You can use everything you want, and you can find a way to use the forecaster. No worries. What is the seasonality? Very simple. As you can see here, what does 3, 5, 7, 10, and 15 years means? Very simple. For example, in the 3-year seasonality, we take from the chart of the S&P 500 from 1st of January until the end of December for the last 3 years. So in this case, we have 2024, 2023, and 2022. And we simply do the average of all this chart, and we have an average. Okay. So in this case, as you can see, is always really nice to see this kind of chart, because as you can see, even if you use the last 3 years in order to have an average of what happened on the S&P 500, or you use a 15 years average, actually you can find the same trends during the years. Okay. Try to imagine, probably you already know seasonality, but if not, it's very simple how to use this very nice tool. It's very simple because, for example, on the S&P 500, as you can see, even if you use the last 3-year average or the last 10 years average, you can definitely say that starting from the end of January until the mid of March, you have a downward movement. You can say something similar but opposite, for example, here. As you can see, using the last 3-year seasonalities, which is the average of the last 3 years, or the last 10, 15 years, you can definitely say that you can find the same trend, for example, in a period, in a window period, which is between the very beginning of May and the very beginning of September. Okay. And this is something amazing because when you do the average of such long period of time, and you can find the same trend both on the last 3 years and the last 15 years, it means that we have a seasonal pattern on a index like the S&P 500. Just to be 100% clear, you can find this kind of trends on every financial instrument across the globe. Also on FX, also on stocks, also on everything. Many people think that this kind of trend, this kind of seasonality are only on commodity. It's not true. You can find seasonality on every instrument all across the globe. Okay. So for example, in this case, we know that we have specific pattern during the years. And of course, you can scroll down. Look, we can just close this specific highlight, because as you saw, if you go directly on the chart, you can ask to the forecaster terminal specific statistics about a specific time frame, a specific period of the year. But if you just scroll down the page without highlight any parts of the chart, you can find the average for a daily average. Let's go here and let's switch off 15 years so we don't get confused. For example, now we are in April. We are on the 29th of April, and here you have the statistic for this specific date. So for example, if you go back 3 years, only 50% of time, this specific day was a long day. If you go back 5 years, on average, in the last 5 years, the day 29 of April was long 75% of time. In the last 7 years, 80%. In the last 10 years, 57%. You can also find the weekly average. You can also find the monthly average. Okay. So, for example, what is very interesting, since we are approaching summer, talking about the S&P 500, in the last 3, 5, 7, and 10 years, every July were a long period, were a long month, okay? And this is an amazing statistics in order to understand if it's time or not to buy a specific time frame, okay? At the moment we are in April, next month will be May. May, we can definitely say it's a bullish period for the S&P 500, okay? Of course, you can also highlight a specific period, okay? And you can have specific statistic for this specific period, okay? And for example, here you can see that in this specific period, in the last 3, 5, 7, 10 years, you had 100%, 80%, 85% of time, 80% of bullish prices, and you also have the average return. What is very interesting, for example, in this case, is that we have an average return which is very similar, even if we use only 3 years and we use 10 years, okay? It means something really easy. In this specific time frame, in this specific period of time, we have a recurring pattern in prices for the S&P 500. What is very interesting, for example, is the correlation. At the moment, for example, we know that the current prices, which is the current year for the S&P 500, is very highly correlated only with the 3-year seasonality. So, for example, in this case, what we can see, what we can do is something very easy. We can switch off all the other seasonalities because we know, thanks to the correlation, that the current year is moving very similar, 79% similar, like the S&P 500 did on average in the last 3 years, okay? We can also add the last year, and we can see that the current year is moving very, very similar like it did in the last year, 71%, and in the last 3 years on average, okay? This is an amazing information because, for example, if we highlight on the chart starting from today until the mid of July, we can definitely see what we can expect from the prices because we know that today prices are moving exactly like they did in the last year and like they did in the last 3 years on average. And so we can definitely see what we can expect starting from today until the end of July, I think I said. Yes, July. Okay. And this is a very powerful tool because we know exactly, thanks to the seasonalities and the different seasonalities, if a specific period of time is bullish or bearish, okay? So for example, we go here, we know that May, it's a very bullish month, but we can also see, and we can also be more specific, and we can say, okay, but we know in the past the S&P 500 was very bullish in this specific period, but today we know that the S&P 500 is moving like it did in the last 3 years and in the last year. So we can be more specific in order to get statistics in order to try to guess what we can expect from the market. Okay? Is everything clear, guys? Since now, let me see if you have any specific questions. Damian, what is correlation? As always, guys, remember that you always have the info box where we explain everything. The aim for the Forecaster terminal is not to be a black box. We really care you understand everything about the software, and we share all the formulas and data you find on the Forecaster terminal. We really want you to understand what you are looking for, and this is why we always explain what you are looking for. So for example, correlations show how two things move together. If they are positively correlated, when one goes up, the other usually goes up too. Very simple. We use the Pearson formula to measure the relationship between the current price and different seasonal patterns. It tells us how closely changes in one thing's match changes in another, and is calculated over 60 business days. Okay. If you would like to be more specific, okay, you can go to Google and you can write Pearson correlation, Pearson formula, and as you can see, you will find exactly the formula we use in order to understand if a specific, let's say, line, because we are comparing lines, are moving with or without a correlation. So for example, in this case, we can see that the correlation is quite high, okay? And you will find the green, which means high correlation, when the correlation is above 70%. You will find you will find yellow correlation, so which is not good or bad, when the correlation is between 30 and 60, okay, and 70, and you will find bad correlation when it's below 30%. For example, in this case, if you leave only the 10-year seasonality, we can definitely say that the current year is badly correlated with the 10-year seasonality. It means that if you take what happened on average in the last 10 years, we have a bad correlation. This is why it's better to focus on what happened in the last 3 and the last year, because we know that right now prices of the current year are moving with a high correlation with the last 3 years seasonality. Okay? Let me see if you have other questions. Okay. Damian, please let me know what you don't understand. If you please try to be very specific with your questions. Let me see. Okay. If you go here, you can find the trended version of the seasonality. If you click it, very simple, you take away the trend from these lines. Okay? What does it mean? Very simple, also in this case. If you go to Google and you write the trended price oscillator, you will find on Wikipedia, for example, a specific technical analysis indicator, which is a very simple indicator because it goes on the chart you are looking, and it will take off, it will take away, sorry, not take off, take away the trend. Okay, for example, here you have an example of a chart, and here below you can find the trended version of this chart. As you can see, highs and lows are the same you can find on the chart, but the aim of the trended price oscillator is to create a chart without a trend, so you can understand if there is a specific, let's say, trend, a cyclical pattern inside this chart. Okay, so for example, in this case, as you can see, if you take away the trend from this seasonality, you can be more specific in analyzing and finding lows and highs. Okay, very simple. This is something very simple, and I mean, to be completely honest with you, I don't use the trended version so often, because what I'm looking inside the seasonality is a specific trend in a specific moment. Okay, so for example, let's be very practical. What can we say regarding S&P 500 seasonality at the moment? Simple. Look, if we go here, we know that the current year is moving 79, more, almost 80% like the 3-year seasonality. Okay, so we can do something interesting. We can leave only the 3-year seasonality, and for example, in this case, we can highlight this specific period on the chart, and as you can see, we can find a little downtrend. Okay, and we can be more specific in analyzing this period. Look, in the last 3 years, if we have been short, okay, 60%, 66% of time we had a profit with an average return of 4.6%. Okay, if we in the same period have been long, we had only 33% of profit with an average return which dropped to 2.4%. What this data means is very simple. We are talking about this specific period of time in a moment where a drop in prices for the S&P 500 is more probabile, possible. Thank you, Michele. Is more possible than an upward movement. Okay. Yes, we have, as Anil is writing in the chat, a higher probability for a downward movement in this specific period than an upward movement, because both the winning rate and the average return increase if we highlight a short trade. Okay, As you can see, you can use this specific tool for the S&P 500, but you can use seasonality for all the others instrument, and of course we will do example during this masterclass. Okay, of course we can also we can also focus our attention not on let's say these short periods, okay, but of course we can also focus on more long-term chart. And in this case, for example, we can definitely see that during a specific period, which is between the, let's say, middle of May and the middle of August, we have a very bullish period, because in the last 3 years, 100% of time in this specific period, we had an upward movement with an average return of 7.5%. Okay? If we add, for example, 5-year seasonality, the 7-year seasonality, the 10-year seasonality, we can definitely say that exactly like the 3-year seasonality, during this specific period, they moved very similar. Okay? So we can go here and we can check the statistics and we can say that it's high, very, we have a very high probability that during this specific window of time, we will have an upward movement. Okay? Why? Because in the last 10 years, we had 90% of time a bull trend with an average return of 6.5%. Okay. And look, the only year just below the statistics, we add all the single year divided. Okay. The only one year where we add a negative return, it's 2015, and the negative performance is only minus 0.14%, okay, which is actually, we can say, it's not negative, okay, because it's a very low negative performance. Okay, so in this case, we know that in this specific period we have a very bullish probability. Okay, and at the moment we also know that prices are moving very, very close how they moved in the last 3 years on average. And so we can definitely say that this is the return we can expect in this specific period. Okay? Is it clear, guys? Seasonality? Perfect. Now we can switch to another layer, okay? Because we can go to do a more in-depth analysis using, for example, the overbought and oversold. Overbought and oversold is a more statistical, technical, mathematical approach. If with seasonality we use all the data coming from the past in order to understand if we have a specific pattern or not, with overbought, oversold, we use different kinds of indicators. All these indicators are based on statistical and mathematical data. Okay, so let's go, for example, here. What we can find is this indicator, which is the market mood meter. It's a very nice indicator. It's something inspired by the fear and greed index, which is an indicator made by the CNN. And this indicator is telling us if at the moment in the market we have fear or greed. Okay? In general, when on the market we have fear, it's time for a low to be made. When we have extreme greed, it's time for a top to be made on the market. Okay? This is exactly the same concept, but this indicator is created with the technical and mathematical and statistical analysis. And what is really nice, you can find also an historical chart for this data. And of course, what you can find is that it's very interesting when prices goes in the lower part of the chart, because in general we can find lows on the S&P 500, but it works for all the other instrument, when of course this kind of when prices sorry again, I start again. um, as you can see, when the market mood meter is in the lowest part of the quadrant, as you can see, the markets tend to do very important lows. Okay, this market mood meter is a combination of three different um, indicators. We have the advanced DPO, which is the indicator you can find here, which colors the chart with green, blue, orange, and red. It depends if the prices are overbought or oversold. It's a combination also of Wyckoff. Wyckoff is a very interesting indicator. Of course, guys, everything is explained. Okay. So, for example, talking about the Wyckoff is a very interesting indicator because it tells us if the numbers of buyers are exceeding the number of sellers and vice versa, of course. So, for example, as you can see here, you have a zero line. When the indicators stay on zero, it means that exactly in that moment we have the same numbers of buyers and sellers. What is very important, we use these indicators like we always used all the technical analysis indicators. We search for divergence. So, for example, in this case, as you can see on the S&P 500, even if the prices were dropping down, okay, we have the number of buyers which are increasing. Okay, very simple. We also have the speed, which is another indicator where we find where we try to find divergences thanks to this indicator. Give me a second. Okay, perfect. This is another indicator that works the same like the Wyckoff, but as you can find here in the description, we use the velocity, the speed formula in order to calculate the speed, the velocity of prices, okay? We use the same formula you can use to calculate the speed of a car on the street, but we use it for calculating the speed of prices. You can imagine, for example, you have to imagine this is not a price, this is a car going on the street, okay? What we do with the speed with speed indicator, we calculate the formula. We calculate the speed of the prices. And this is something really interesting because once you calculate the speed of prices, you can definitely find some specific moments, okay, for example, like it happened here on the top for the S&P 500, where the speed of prices start to drop, but the prices continue to go up. And here we can find what we call a divergence, because prices are going up, but at the same time, the speed is telling us that something inside the trend is changing, okay? And that's it. And this is something really important because we can definitely analyze how prices are moving, and we can understand if it's time or not to buy. Okay. Market mood meter is a sum of all these three indicators: advanced DPO, Wyckoff, and speed. And we have just one indicator that is telling us what is happening on the market. And as you can see, here we had, for example, a first important low here with the indicator that drop below the minus 100 level. And then we started to have divergences between the indicator and prices. And this is what we are looking for. When we start to see divergences on between the indicator and the prices, we can definitely say we are close to an inversion in prices. Okay. Of course, you can use this indicator just to understand and just to know we are close to a low, or as we explain on our website, you can go on Forecaster.biz website, and you can go, for example, in market mood indicator. We explain with a real example how to use this indicator in order to get a timing signal, a buy entry point or a sell entry point if you are on tops. Okay. So in this case, very easy, talking about the S&P 500, we can definitely say that we experienced in the recent weeks a oversold situation, and an oversold situation, which also called panic selling, is a specific moment where markets tend to perform a lows, okay? Tend to do a very important low. And this is why at the moment we can definitely say that the oversold and overbought analysis we just did, it's in line with the analysis we did with the seasonality. Okay, that's it. Okay, if you if these two different analyses we did with the forecaster is not enough for you, you can also go deeper, and you can also go to the COT report. And for example, in this case, you can find something very interesting because you can find all the participants at this huge market, which is the futures of the S&P 500. And for example, in this case, you can find a very interesting situation. Let's go back very quickly to the CFTC Commission website. And for example, here you go to financials, okay? You can find all the futures for the CME, okay? You can find everything. And of course, you will find if you scroll down, you can find also the S&P 500. Here you have, for example, the long position for the leverage fund and the short positions, okay? This is not a very nice page where to understand how they are trading on this specific market, because you can find just one data, okay? What we do at Forecaster, we collect all the historical data and we plot the data on the chart. And what we do is trying to understand if we have a divergence between prices and the volumes of a specific category. For example, talking about the S&P 500, we always look for leveraged fund. We are talking about the hedge funds and non-commercial. Also in this case, guys, you have the description of what you are looking at directly inside the forecaster, okay? So for example, if we would like to analyze the COT report for the S&P 500, we can definitely say something really interesting, because look, these are the net positions. It means we here on the chart, we find long positions minus the short position for this specific category, leveraged fund. Okay, we have both the long, the short. We can also see a different kind of chart. I really love the bar chart in this case. The net position are the long contracts minus the shorts. What we can see here is something really interesting, because during the last drop in prices, hedge funds closed a lot of short positions. And this is something really interesting, because as you can see, we have a very strong divergence in this case. And this is another analysis on another layer in the forecaster that tell us that probably we are on a very important low for the S&P 500, okay? Of course, you can go deeper for the COT report, and you find a complete course, a complete masterclass about the COT report here. You find it inside your forecaster terminal, and you find a complete COT report course, okay? Don't worry, because we will have a look to COT report even in the next chapter of this masterclass, because COT report is very important, for example, for commodities, currencies, and all the future available on the CME, okay? But talking about the S&P, we have a divergence, because during the last drop in prices, the leveraged fund used the last drop in order to close a lot of short positions. And this is a bullish sign, okay? If you have not enough analysis, you can also go to the ranking page, where we can find something really amazing. Because inside the forecaster terminal, we have, for every single stocks listed across the globe, we have the fair value automatically calculated by the forecaster. What we do for every index is taking all the companies, the components for the index, and calculate the average fair value for the entire index. And in this case, we can definitely say that the entire S&P 500 is undervalued by 16%, which is something really amazing, that tell us that probably we are on a very important low, because we have an index where the companies are making money, as you can see from the global net income for the S&P 500, But fundamentally speaking, we are talking about an index which is undervalued by 16%. And this is a very nice layer, the ranking, because you can analyze only the top 10 shares and they are undervalued too. And you can find the pie chart that tell you how the sectors are divided. You can analyze the top 30, you can analyze the top 50, and you can analyze a specific sector. For example, if you would like to have a look inside the healthcare, we can definitely say that the healthcare sector is really undervalued. Okay? If we go, for example, here to all shares, all stocks, here you can find the value layer where you can find all the fundamental analysis factors. We will deep dive inside this page when we will talk about the next week regarding shares and companies. You have the ratios, the traditional ratios, and you also have the price change, the performance for the stock. Okay. On every layer, you find the best to worst button. If you click the best to worst button, very easily you can find which are the best companies ranked by average of these datas, both on value, ratios, and price change. Okay, guys, for today's we have to stop here, but be sure to come next week because we will deep dive again inside this masterclass regarding the Forecaster Terminal. I hope you enjoyed. See you next week. Thank you very much and see you next week. If you have any questions, please send your question to info@forecaster.biz. I will be more than happy to reply to you. Welcome to the second lesson of our Forecaster Terminal Masterclass. In the previous lesson, we saw how to forecast, how to predict stock indexes thanks to the Forecaster Terminal software. You can find on our YouTube channel the previous lesson if you lost it, of course. Everything is recorded. Today, we will talk about stocks, okay? We will talk about companies which are listed on stock market, okay? And it's a very interesting lesson, this one, because we will go through all the different type of analysis you can do thanks to the Forecaster Terminal, and you will understand how to mastering this software, which is very powerful also on shares. Okay, so as I told you in the previous lesson, the forecaster, you can use the Forecaster Terminal in two ways. The first one, as you can see, is going inside the Forecaster Terminal, which I would like you to remember that it's built like Google. As you can see, you have a search bar where you can type something, and you can also use all the tools from Google. Exactly is exactly what you can do with the Forecaster Terminal, because you can go directly here on the search bar where you can find all the financial instrument, and of course you can go here and exactly like a Google, you can go through all the tools available in the software. Okay, so as I told you in the previous lesson, you have two ways for using the Forecaster Terminal. The first one is going directly to the search bar where you can find every instrument that you like. So if you would like to analyze a specific instrument, a specific stock, a specific index, a specific commodity, you can go directly to the search bar. Or if you're looking for investment or trading ideas, you can go through the tools you have available in the software. Okay, so you have these two separated ways to use the forecaster terminal, and of course it depends on what you have to do. So let's go to the forecaster terminal. Today we will talk about stocks. So let's start, for example, with one of the most famous stock that you can find nowadays on the stock market, and I'm talking about Nvidia. Okay, as always, the forecaster terminal has many different layers. We have, for example, the overview, the seasonality, the overbought, oversold, fundamentals. In the case of Nvidia, which is an American stock, you have also the politician. Okay, this is this design for the forecaster was we made the forecaster this way because we like to analyze the same instrument with different approaches. Okay, so for example, you can analyze Nvidia through a fundamental point of view, and you can find all the data, and we will deep dive in this approach, don't worry. But you can also analyze Nvidia prices, share prices, thanks to a more mathematical, analytical, statistical approach. Okay, of course, these two approaches are completely different, but at the end of the day, the goal is to find out which is the result of the analysis, thanks to a complete different approach. So it's like to use different lenses to see the same stock in order to understand what is gonna happen on this specific stock. As always, guys, you have your chat, so you can ask me anything you want. I only ask you to make related question to the topic. So let's start from the first page of a stock. We are, as I told you, on Nvidia, but what we are saying right now, it's the same for every companies all across the globe. Let's start from the overview page where you can find, of course, the chart with all the 1 month, 6 month, this year, 1 year, 3 year, 5 years, 10 year, and 20 years performance. And something really interesting you can find is the sales, net income, price earnings, and dividends directly on the chart. This is particularly interesting because this tool, the possibility to have sales and net income and all the other information on the chart directly, is very important, because as you can see, when you plot the earnings, for example, on the stock chart, you can definitely see that prices tend to rise for the stock when the earnings rise, and prices tend to fall when the earnings fall. And as you can see right now, for example, it's not the Nvidia shares skyrocketed in the last 2 years, not because of something special we don't know, but because the company made a lot of money. Because as you can see, let me do a zoom on the chart so you can see much better. If we zoom in, as you can see, it was 2023 and the company had only, let's say, 4.37 billion in net income. The next year, which is 2024, the company had 29 billion. And right now, in the last year, the company closed with a $72 billion in net income. And this is something amazing that that allow the prices of the company in the stock market to rise. But as you can definitely watch from this chart, where you can find both the share price and the net income is that the price for the shares goes exactly where the results are. This is why we can definitely say that the stock prices are driven by the company result. And this is something really interesting because it's something that in the long run tell us exactly where the company will be probably. Okay. And this is something also very interesting because sometimes happens that in the short term the market is really pessimistic due to many things, like for example now it's a little bit pessimistic because of Trump tariff. Okay, and as you can see, what happens is something really nice. And what I mean is this: if you plot, as we always do, the net income on the chart directly on the prices, for example, at the moment, you can definitely say that we have an upside opportunity here. Okay? Because the stock prices tend to reach, they are attracted somehow from the net income line. And for example, let's do a very nice example on another stock. Let's go, for example, on Microsoft. If we go on Microsoft, which is at the moment the biggest stock on the S&P 500, as you can see, in the long run, prices tend to stay on the net income line, but sometimes it happens that prices, due to let's say a pessimistic view for the moment, go very far from this line. Okay, it happen also the contrary. For example, sometimes prices are investors are too optimistic and the share price go far above the net income line. What happen in the long run? The price of the share tend to be at this equilibrium point, which is the net income line. When, for example, the prices go very far from the net income line in the lower part, they go down, let's say, it's only matter of time they will reach again the net income line. Of course, this is something very interesting because it gives us a very nice opportunities when we have, for example, right now on Microsoft or on Nvidia, as I told you before, a company which is performing very well. Okay, fundamentally speaking, for example, Nvidia is doing great with the earnings. Okay, but because of tariff, because of the geopolitical situation of Taiwan, which is the country where the chips are made, and many other things, we had a downturn. But at the same time, the um, the net income level is still very high. Okay, so we have a very strong buying opportunity, and this tool is very nice because we can see it, we can see the opportunity very easily in a very quick way. Okay, so for example, we talked recently about Microsoft, and as you can see, this is the proof that these, let's say, this little tip works really fine. Because look, for example, we had, starting from the beginning of 2025, a drop in prices, but at the same time, as you can see, the net income is growing. You have to remember that this number is the T TM data. It means it's the trailing 12-month data. It means that we um, we we add the last 4 quarters. So in this case, here you have the sum of the last 4 quarters, the net income for the last 4 quarters, and this is the best way to understand if a company is growing or not the net income, okay? Because you have the most updated situation for the company. Of course, if you switch, but we will deep dive very soon to the fundamentals, to the fundamental layer, and you can go to the raw part where you can find both the income statement and the balance sheet. You can find here the TTM, which is, as I told you, we have to switch to the quarterly. It's the sum of the last 4 quarters, okay? And this is amazing because, for example, in this moment, we can definitely understand how the company is doing right now because we are using data that are coming both from 2025 and 2024, okay? And this is really amazing because, for example, in the case of Microsoft, we can see on the chart, on the overview chart, that the results are going up. And in this moment, if the year ends right now, the net income for the entire year would be $96 billion, which is higher than 88 that the company did at the end of 2024. Again, in the overview page, we can also find the year's performance for the company we are watching, divided year by year. We can see something interesting, which is the dividend, and the software is telling us if the dividend is increasing or decreasing. And in the case of the dividend in Microsoft, it's increasing. And then something really interesting, we can find the insider transaction. Insider transaction tell us if a member of the management is buying or selling shares of the company. This data is very interesting only when a member of the board buy stocks, okay? Because probably if you have a look to all the companies listed in the United States, many times, lot of members of the board, also in this case the CEO, are selling shares. We don't know why they are selling. Maybe they need money for something else. Maybe they need a compensation for their job. And this kind of compensation is very efficient in terms of taxes. Okay, so the important thing is when an insider, someone from the board, is buying. This is a very interesting situation because uh, they buy just because they would like to make money, and if they believe in the company, if they know something we don't know, if they buy, they definitely think the company is gonna do great on the stock market. Okay, so this is something really interesting to analyze when we would like to see if a company has an upside potential or not, because if someone from the board is buying, is such a very interesting thing. Talking about the first layer, we said everything. As I told you, it's really interesting this tool we decided to have inside the forecaster because it gives us very nice opportunity, okay, very nice opportunity on the stock market. For example, recently we talked about Palantir, and if we go to Palantir, as you can see, the um, the the company is now really skyrocketing on the market. Today they released the earnings, and even if the earnings are really nice, the company is dropping on the stock market. But for example, in this case, many times during the last month, the company went down a lot, and every time the company went very far from the net income line, it was such a great opportunity. I have many examples of this little easy tool from the past, but for example, one of the best trade we did a few months ago was on Lululemon. And look, Lululemon, for example, at the moment is very interesting because look, I can make an analysis with you. As you can see, in the long run, stock prices follow the net income, okay? And at the moment, for example, the net income line is suggesting us that these shares should stay at the top, not at the bottoms. And for example, it was the middle of 2024, and we bought these shares because the net income was skyrocketing, but the prices were falling. And in that case, the company was falling because Nike, which is in the same sector, was falling, and the investor was really pessimistic regarding the entire sector. But at the end of the day, if the company is making money, at the end of the day, also the share price will go up. Okay, so this is something really interesting to watch because you know exactly where is the opportunity. For example, regarding Tesla, you can see that, for example, when the share was here at the top, if you go back to our videos, we made a different video regarding Tesla. We said it's now time to sell at least a portion of our position on Tesla because the company is really too far from the net income line. And look what happened. Prices fell down and they reached exactly what we call the equilibrium level, which is the net income line. Okay? This is really amazing. This is really an amazing tool because it allows you to um, to 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 jump in a stock which in this specific moment could be in a very pessimistic mood from the investors, okay? Or you can understand if a company, for example, like Tesla did a few months ago, is in a too optimistic phase of his life, okay? Look at this point, for example, it was the beginning of 2023, and as you can see, Tesla was doing great. But for some reason, I don't remember, the company was dropping on the stock market. And then what happened is history. And then we had exactly the opposite situation. The, the there were so much optimism on the market, but at the same time, the fundamentals of the company were doing bad. And at the end of the day, what happened to the share prices follow what is happening on the fundamentals of the company. So of course, Scott is saying in normal market condition, Lulu look like a good time to buy, but the whole tariff situation makes we wonder if we can take that trade. Current earnings are based on past and current inventories. Of course, Scott, of course, and we cannot predict exactly the future, but at the end of the day, you can do an evaluation and you can understand if this company is good for the long run or not. Of course, of course. We cannot predict the future, but if the situation is good enough, if the company is good enough for the long run, could be a really nice buy right now because the stock is very low, of course. Perfect. So let's move to the other layer, which is the seasonality layer. Okay, let's go back to NVIDIA, which is the example we are using today. Seasonality. We talked a lot about seasonality when we did the first lesson. Remember to see the first lesson, to watch the first lesson on our YouTube channel if you lost it. But I know it sounds counterintuitive, but seasonality works really nice also on shares, not only on commodities, not only on indexes. It really works also on shares. And as I told you in the previous lesson, what is seasonality? Very simple. The best example of seasonality I can do for you is the temperature of New York City. If we see which are the average temperature of New York City, as you can see, let's go here. We have a January in New York City where we have a very low temperature, and then we go up until July, and then again we go down until again November, December. And this is a cycle that we can find because we measure the average temperature in New York City. Okay, so what we do with the seasonality is something exactly the same. If, for example, we plot the 10-year seasonality for NVIDIA, what we do is something very easy, because we take the chart of NVIDIA starting from the 1st of January until the end of December for the last 10 years. So we take 2024, 2023, 2022, 2021, 2020, 2019, 18, 17, 16, and 15, the last 10 years. And we do the average of all these charts, okay? And what we find is an average of the last 10 years. Very simple. What we can find inside this 10-year chart, 10-year seasonality, are patterns. So for example, in this case, as you can see, starting from the very beginning of May until the very beginning of November, in the last 10 years, on average, we had a very strong performance, okay? Because if we go here, we highlighted all these piece of chart, okay? In the last 10 years, exactly in this specific period, we had 80% a bull run, a bull trend 80% of time with an average return of 74%. And here you can find all the single years as you can see, 2022, 2021, 2020, 2015, as I told you. And for every single year, we can find the performance for this specific period, okay? In the case of NVIDIA, it's very simple to see a very strong pattern during all the central part of the year. Of course, if you remember from the previous lesson on the stock indexes, you can find a more, let's say, a more erratic situation, okay? But for NVIDIA, we can definitely say that we have a bullish pattern exactly here in this part of the year, okay? You can find all the statistics, and you can also find the monthly average, for example. And as you can see, as you can see, for example, in May, in the last 10 years, 80% of May was a long month, okay? So 8 out of 10, we had a positive return, which is very interesting, okay? This is very interesting, but of course, this is what happened in the past, and we are not sure is gonna happen also in the future. Could be, but this is only a statistics. This is why we added to the forecaster terminal the correlation tool. The correlation tool is something really interesting because it tells us if the current price, which is here in pink, as you can see, is correlated or not to the seasonality you are watching. So for example, in this case, the current year, the current price, is not correlated with the 10-year seasonality at all, okay? Because it's only correlated almost 22%. It means on 100 days, only 23 days are doing the same of what it happened in the last 10 years, okay? And this is a very nice information because if the current year is not doing, is not performing as the seasonality, it means it's better not to use that seasonality. So what we can do, we can just go to the chart, to the seasonality tool, and we can add all the other seasonality. Let's add all the seasonalities. As you can see, the only one at the moment with a very high correlation is the 3-year seasonality. It means we can only keep that seasonality on the chart, the 3 years, okay? And in this case, we can see that the prices, the current prices, are moving exactly like they did in the past, like they did on average in the last 3 years, okay? So it means that we can definitely um, we can we can definitely expect something like it happened in the past, okay? In this case, if we go here, we can find that starting from next week, we can expect a rise in price for NVIDIA of 36%, okay? On average, of course. If you go here and you see what happened in every single years, okay? We know that current prices are moving at almost 80% like NVIDIA did on average in the last 3 years. So in this case, we can definitely we can expect this kind of return for the next month, okay? Because the actual prices are moving like the green, like the yellow line, okay? And so we can go to the software and ask what we can expect here. We can definitely see that we have a pattern here, okay? We have an upward movement. We know that the actual prices are moving exactly like they did on this yellow line. And so this is what we can expect if the correlation remain high, of course. This is not sure at all. This is something that can change, but it's something interesting. And this is why we would like to use different lenses to analyze NVIDIA. Because, for example, at the moment, we know we have an upside opportunity here because the company is doing great with the earnings, but the prices fell down in the last weeks, okay? And seasonality is telling us that we have an optimistic window which will start from next week until the end of August, okay? Can you see what we are doing? We are building a prevision for NVIDIA company that is starting from a fundamental point of view, is switching now from a seasonality point of view. And what we are looking if with the different lenses, with different analysis, we can find a common a common situation. We can find the same result. We can find the same output, okay? Perfect. So in this case, we can definitely see, we can expect an upward movement until the end of August, okay? And of course, if we go here, we can expect a downward movement in the next few days, and then an upward movement that can have a very interesting 37 average return for 3 months. Okay, this is really interesting. Of course, you also have the daily average, which is something interesting. And in this case, I don't use it a lot because I don't do day trading on stocks, but it's very interesting because, for example, if you plot the 10-year seasonality, you can find days, for example, which are very bullish. For example, the 14th of May in the last year, the 14th of May in the last 10 years has been a long day 100% of time. This is very interesting, especially if you like to trade on a daily basis, okay? Philip, I use the days for my Forex backtesting and it works incredibly well. Yes, exactly. This is something that we will see when we will talk about the Forex, but these statistics are really good if you like to do day trading or very short-term trading. This is a statistic that really is really nice, both for the long and the short. So at the moment, we saw the overview, we saw the seasonality, and in both cases, we have an upside potential, okay? Let's switch to another layer, another type of analysis. We are on the overbought and oversold page where we can analyze prices in a more mathematical and statistical way, okay? This is, of course, the chart for NVIDIA, okay? This is exactly the chart we saw until now, but in this page, we treat this chart as a series of data, okay? This could be, for example, the chart of your temperature if you are in the hospital. This could be the number of banana a shop is selling in I don't know where, in Brazil. I don't know if they do, if they make bananas in Brazil, but this could be, this is just a series of number, okay? This is not this is, I mean, how can I say, we treat these series of number as a series of number and not like a chart, okay? And in this case, we have different indicators on the chart. The first one is the advanced DPO. The advanced DPO is a very clever idea we had here at the Forecaster terminal, because it's something really interesting. First of all, what DPO is? DPO indicator. You can also find the Wikipedia page for this, the trend price oscillator, DPO. Okay, this is a very simple indicator because it takes away the trend from a chart. Very, very simple. I can do a very simple example here for you. So this is a chart, a normal stock chart with an upward move, a trend, an uptrend. Okay, the DPO is doing something really, really easy. It takes the chart and it take away the trend from the chart. So in this case, this is the normal chart, let's say the Nvidia chart, and this is the chart with the DPO applied. What we did is just taking away the trend from the chart. As you can see, I'm not an artist, so I'm not very precise, but as you can see, the chart is the same with the same highs and lows, okay? But what we did is something very simple. We took away the trend from the chart, and we have a flat chart without the trend inside, and we apply the 200 Bollinger Band. We definitely find every point where the prices are statistically high, okay, and all the points where the prices are statistically low, okay? Very, very simple. If we go here to the Forecaster terminal, we called it advanced DPO just because we didn't plot the Bollinger Bands, but we just colored the phases where the prices hit the lowest part in green of the Bollinger Band and the highest part for the Bollinger Band. Okay, so in this case, we have this first indicator that tell us if statistically speaking, prices are too high or too low. Okay, and in this case, talking about Nvidia, as you can see, here we are on Nvidia, the previous low, this area, were a major low point because prices were colored in green, okay? And this is why the software colored in green the prices, because it means we were here, okay? Very, very simple. This is not the only indicator we have on the platform, because we also have the speed indicator, and the speed is something really interesting because, as I told you, we are using this chart not as a price chart, but as a signal, okay? This could be everything, as I told you, could be your body temperature if you are in the hospital, or can be the movement of a car. Okay, so in the case of speed, we do something really easy. We imagine this is not a price, this is a car, and what we do is calculating the speed of the car with exactly the formula you can use in order to find the velocity of a car. Very simple. And this is something amazing because you have to imagine this price chart as a car. What is happening when a car is approaching, let's say, a turner, turnabout? Very simple. The car decrease the velocity, and then when it go outside the, give me a second because I have to translate something. Roundabout, yes. When it goes out the roundabout, it speed again, okay? Very simple. Exactly what it the car did here, okay? And how we can see if the prices are decreasing or increasing in velocity? Of course, we can find here. Look, very simple. For example, in this case, this was the lowest point for the chart, okay? And as you can see, let me paint better. This is the lowest low, which as you can see was lowest than the previous low, okay? But look here, what happened. Even if the prices were lower than the previous low, the speed of the prices did not a new low. So in this case, as you can see, you had a new low, and of course, watching only this chart, you can imagine the company, the stock price is falling. But as you can see here, the speed of prices were already decreasing. Okay. And look what happened later. The prices start to rise again. Then they came back. And here we are with the prices that are crossing the zero line, because this in black it's the zero line. Okay, very simple. As you can see, this is exactly the zero line. Okay, and this is where you have the confirmation that the trend has changed. Okay, of course you can use it also on the other side. Let's go, for example, here. Okay, here it was the end of October and Nvidia made a top. At the beginning of November, Nvidia made an higher high, but at the same time, the speed of the prices went down. Okay, and these tell us exactly that prices are doing a turning point, because prices went up, but the speed of prices went down. Okay. So for example, analyzing at the moment Nvidia, we can definitely say that this low was a very important low. And at the moment, both the advanced DPO and the speed indicator is telling us that we are on a very important low. Okay, we just saw a very important low. We also have another indicator, which is the Wyckoff. Very simple. Also here we have a zero line. When the indicator is right like now at zero, it means we have the same number of buyers and the same number of sellers, okay? Also in this case, what we are looking for is a divergence between prices and the indicator. Look, for example, the Wyckoff, what happened. As I told you, when we have zero, it means the number of buyer equal the number of sellers, okay? What is important for us is to search for divergence. So for example, look, here we have a very big divergence between prices and indicator, because even if prices went down a lot, the number of buyers increases, okay? Look, here we have a very important law. Here we have another law which is higher than the previous one, even if prices went down a lot, okay? This is a divergence, and this is what we are searching on every indicators we have on the platform, because we have to find the opportunity in a specific moment where the market is in panic, for example, right now, okay? If we go back to NVIDIA, okay, also here you can find an interesting situation, of course, because, for example, on all these downward movement, as you can see, for example, here you have an important low for the indicator, okay, and here you have some lows here, and then the prices went down, but at the end of the day we didn't have new lows. We have such like a plateau in the number of sellers, and it means in this case that we are on important low in this moment. But anyway, sometimes we understood it was a little bit difficult to analyze all these different indicators one by one, okay? So we created the market mood meter, which is, as you can see, an average of all the indicator. As you can see, you have advanced CPO, Wyckoff, and speed. We merge all these indicators and we find an indicator which is very effectively saying if the stocks is in an overbought situation or in an oversold situation, okay? We can definitely see if the stock prices is statistically speaking too high or too low, okay? And for example, in this moment, we can definitely say that here, during all this period where the NVIDIA shares just did the sideways, okay, the indicators is telling us that the buying pressure is growing and growing and growing, okay? Look, you have what we call a very strong divergence in this case. It's really interesting, okay? We can go, for example, also to Microsoft, and we can definitely find the same situation here. Because look, starting from the beginning of 2025, shares of Microsoft went down, but look what happened to the to our indicator. It was here below zero line, which is what we call the oversold or panic selling zone, which is exactly the best place where to buy shares because it's exactly where lows usually been made. Roberto, what do the green and red column means? Very simple. The indicator tell us here, for example, when it become green, when we have an extremely oversold situation. As you can see, when the indicator reach the minus 100 level, you see the green, okay? Because it's very probable that in this area you will find a low when you have such a panic selling situation, okay? If you go, for example, on Meta, as you can see here, you have a red color because the indicator went above 100 and is exactly when the shares made the top. And here the same, but with the opposite situation. You have the indicator which color the chart in green when it goes below 100, which is a very important panic selling situation. And we colored in red the FOMO situation because in general, when you have a FOMO situation, it's time for a top to be made. And we colored in green the panic selling situation because in general it's when the lows are made, okay? And also in this case, as you can see, we can find a very strong divergence between the prices and the indicator. Look, this one is really nice and really important. You have the share prices that drop again and made a new low, but at the same time, the indicator is starting to reverse. And we have the indicator that is telling us a complete different situation from the prices, okay? This is why, as you know, if you follow this weekly webinar every week, in this area with the indexes and stocks, we were very optimistic for a long reversal, okay? Yes, of course, David, in the future, it will be definitely possible to search opportunities thanks to these green opportunities. Of course, we are working on it. We are working on many different tools that you will find very soon here in the Forecaster terminal. But yes, definitely. Okay. So we saw the overview, we saw the seasonal part, we saw the overbought and oversold, which is a mathematical statistical approach. Let's deep dive in one of my the best layer, which is the fundamentals. Fundamentals, guys, is a very important topic because we at the end of the day, as we saw at the beginning of this lesson, in the long run, stock prices goes where the fundamentals are. If a company is making money, is doing great, stock prices will do great. Very simple. This is the very secret of the market. Okay. So thanks to the fundamental analysis, what we try to do is understanding if the company is doing good and if the company is over or undervaluated. So in this case, for example, talking about NVIDIA, we have three different layers, okay? We have the visual layer where we can find chart regarding the company results, okay? we can find the raw layer where we have all the numbers for the income statement, the balance sheet, the cash flow, both annually and quarterly, okay? And we have the transcription. Every 3 months, when the company release their results, the management is telling something, they comment the results, and here you have all the transcription for every quarter, okay? Of course, you can read it and instead of watching a film with your wife, you can stay all the night long reading all the quarterly, all the transcription. But we did something interesting because we added to the forecaster terminal the AI agent, and in this case, just clicking the button, you can ask the AI agent to give you a resume for all the transcription, and you will have the positive news, the negative news, the risk and concern, which is a very important voice because the management must tell you which are the risk and concern they see for the future, and of course the future outlook, the notable information, and everything you need to know about what the management said. You can also do the same in the raw page, where you can ask the AI agent to analyze the income statement and the balance sheet, okay? And we teach to our AI agent to analyze the data, and this is something very important because as today we use the calculator for doing our math, now we can also use the artificial intelligence to analyze income statement and balance sheet. Okay, let's go back to the visual part, which is which is very interesting because here we can see the financial, and we can definitely see in a fingertip how the company is performing. Okay, so in this case we see that the company is growing both on sales and net income. Okay, we can see also the quarterly. Okay, and we can also see both on annual and quarterly the ratios. What ratios are? Something really easy. We have the profit margin, the ROI, and the debt equity. Profit margin is very simple. Of course, you have all the explanation here. I would like you to remember that the forecaster terminal aim is not to be a black box, but we really would like you to understand the data you're watching, because you have to trust the data you're watching. And if you don't understand from where they are coming from, you cannot trust the data. So every time you see something, we explain to you how we add this result and what is it. Okay, so in the case of Nvidia, here we have a very high profit margin, 64%. It means that every $100 of sales, 64 become earnings, which is an amazing result. ROI, very interesting, return on equity. We can see the ROI, return on equity, measure how much profit a company makes compared to the money its owner, the shareholder, have invested in the company. Okay, very important number. And of course, the debt equity. This is the number of debt compared to the equity, which are the money the shareholder put it in the company. If it's below 1, it means the company has more equity than debt. That in general is a good news. Okay, of course, we have many years, and we have also the quarterly, because it's very important not only watching a single year, but it's important to watch the trend of the ratios. We have to watch both the trend of financial and ratios in order to understand which is the trend of the results. And this is very important. Thanks to the trend of the result, we can calculate the fair value, which is, in the case of Forecaster, an average of three different approaches. We have the discounted cash flow, the Peter Lynch method, and the economic value added. Why we use three different approaches and not only one? Very simple. I show you something. As always, we didn't invent nothing regarding this type of evaluation, but these are methods that you can learn if you go to the economic university. Um, why we use three different calculation and not only one? Because of course these different methods target different parts of the income statement and the balance sheet, and we can have a more resilient result if we use different approach and we use different method that target different part of the income statement and the balance sheet. Okay. I always do an example. How can you, for example, um, evaluate two different person, completely different person, like Usain Bolt and Woody Allen? Of course, you cannot evaluate them with a single method, because if you evaluate Usain Bolt for his velocity, probably he, he will have a much higher valuation than Woody Allen, which in velocity probably, I don't know him personally, but I I really think he is not fast as Usain Bolt. Okay, so this is why we use different method, because of course we are approaching many companies inside the forecaster, and if we use only one method, we can maybe we can maybe evaluate Woody Allen with something that it's not that doesn't fit him. Okay, so in this case, for example, we evaluated Usain Bolt 100 on 100 regarding the velocity, 10 on 100 regarding the creativity. Of course, it's just an example. Age 37 on 100, so the average is 49. Okay, and regarding for example, Woody Allen, we have 1 on 100 in velocity, 90 on 100 in creativity, and age 88. Okay, so we have an average result of 59. This is just an example to let you understand why we use three different approaches. And it's important we don't put any type of biases inside this calculation. What we use in order to calculate the fair value are exactly the original formula for every single method. Okay, and this is what we do. For example, the Peter Lynch method, if you would like to deep dive fair value formula, here it is. It's very simple. It's earning per share multiplied by the earning per share growth rate. Okay, so we have all the data. We have, as you can see, the growth rate for the net income. Okay, and that's it. This is all the data we use for calculating the over and under valuation. Of course, this is not enough, because when you would like to understand if a company is good or not, you don't have only to watch the financials or the ratios or the fair value. You have to understand if the company is solid. And this is why we created the solidity part for the fundamental layer. And here we have three different scores that are really important. The first one is the Altman Z score. Is an amazing score that tell us if the company has a risk of bankruptcy. Also, in this case, we have a public formula. You can go on the internet and you can find here it is, okay, and the forecast the in a safe is in a great zone or as a risk of bankruptcy in the case the result is less than 1.81. Okay, of course, in the case of Nvidia, we do not have a risk of bankruptcy. We have a very high Alt1 Z score. Piotrowski score is another very interesting ratio made by Piotrowski, which is a professor of a very important university. Also, in this case, we have different number. We have also in this case a very simple formula, okay, that you can of course find online, but I can show you better here, okay. The results is a number between 0 and 9. Of course, if you find a company with 6, 7, 8, or 9, it's considered a strong company. How you can calculate this number is very easy because you take 1, 2, 3, 4, 5, 6, 7, 8, 9 ratios, which are, for example, the net income. If the net income is positive compared to the previous one, you add 1 point. The same for operating cash flow, the same for return on asset, the same the quality of earnings. If you have a positive ratio compared to the previous one, you add just 1 point. At the end of the day, if you have 9, it means that you have a better situation compared to the previous one, okay, and you have a solid company. This ratio is very interesting because this is a study from Societe Generale, a very important European bank. And as you can see, they divided all the company from US, Europe, UK, and Japan in groups. Company with a Piotrowski F score of 1, Piotrowski F score of 2, Piotrowski F score of 3, 4, 5, 6, 7, 8, 9, and they realized that if you buy only companies with a Piotrowski score of 9, you overperform the average of the market. And the same happen at the opposite side. If you buy only company with a Piotrowski score of 1, which means it's not performing well, fundamentally speaking, a group of shares made of only Piotrowski score, very low Piotrowski score, it will underperform the market. And this is a very interesting metric that tell you just in a very quickly if the company is doing good or not. And this is why we plotted not only 1 year, but of course the trend. Look, the trend for Nvidia is very nice. Benisham score is another really nice indicator, another ratio, very important, because it tells us if the company is unlikely to be manipulating its earnings. Okay, this is a very popular ratios because I don't know how old you are, but if you go back in 98, students from Cornell University, they applied the Banish model and they unveiled the dark truth behind the Aero Corporation facade. And this is something really interesting because this is the formula. It's a little bit complicated, but of course you have the formula. It tells us if something bad has been done with the numbers inside the income statement and balance sheet. Okay, and um, as uh, as you can see in the past, this ratio helped to find many fraud, like for example the wire card manipulations has been made in 2020. Okay, and as Dr. Lee say, a professor at University of Washington, a rising combined score from 8 specific metrics suggesting a company is growing but also losing its core business strength and could be engaging in aggressive accounting. Even if legal, because of course we don't, this is not a proof that they are doing something illegal, but if they are doing something like that, if they are doing an aggressive um, a, an aggressive accounting, it's better to avoid these kind of companies because they could have problems in the long run. Okay, so these are three ratios very important to analyze the solidity of a company. If the company is solid enough, we can go deeper and we can analyze the value generation, which is another uh, chapter inside the fundamental layer. And here we have a very nice parameter, which is the shares outstanding. Very important because this is the number of shares that are on the market. And if the number decrease, it's something really good for us investors because the value, the intrinsic value of all the other shares that remain on the market tend to grow. Okay, I have a very quick example here for let you understand what is the share repurchasing. For example, if we have a bottle of 1 liter of water and we divide this water in 4 glasses, we have, of course, 0.25 liter for every glasses. Okay. If we take the same liter of water and we divide it in 5 glasses instead of 4, we have, of course, 0.20. Okay. And this is something really interesting because sometimes it happens when that the company is doing great as results, as financials, but on the stock market, the company doesn't grow. Okay. And probably it's something that happens when the company is doing good, but it's also issuing more and more shares. Okay, which is something you can do if the company is doing really, really great. But as Nvidia is doing since 2022, it's better to repurchasing shares because what's happening if you're repurchasing shares, the value, the same liter, if you divide the same liter of water in 3 glasses and not 4, you have 0.33 liter for every glass. Okay, so if we go from this situation to this situation, very simple. The Of course we can do the same example with shares. If you have a company which worth 1 billion and you have 4 shareholder, you have 250 million for every share. Okay, if you add 1 share, the value of the company remain the same, but of course the value of all the other shares drop at 200 million. The opposite happen if you have the company which still value 1 billion and you take away one share from the market, the value of the free shares that remain on the market goes up until and reach 330 million. This is why it's very important to have a look to the number of shares, because in general, what if a company is repurchasing her own shares frequently, it's something that allow the prices of the stock to go up constantly. For example, here we are on Apple, and Apple is doing buyback since ever. Okay, here we are on Meta, and Meta is doing buyback since ever. Okay, it's a sign. Doing a buyback, repurchasing all own stocks is a sign the company, the management think that the company is undervalued. Look, for example, we have ASML, which is a very important company that makes chips, make not chips, but machines that makes chips. If you go here to the fundamentals, um, look what they just did. They just repurchasing lot of shares because the shares went down a lot, and they really think the company is undervalued, and this is why they repurchased a lot of shares. Look, for example, here what we said at the beginning of this lesson. Look, this is a very nice example of a company which is going down because of tariffs, but the results are growing because this is the only company that create special kind of machines for creating chips. And look, results are really going up and the prices are going down. This is a very huge opportunity, and I recently bought shares for this company, which is an amazing company. Okay, and I have the confirmation that this company is amazing, because if we look the fundamentals and we look the share repurchasing, we can definitely see that the management is aggressively repurchasing their own shares. Okay, because look, they did something great because the price is very low. As Warren Buffett said, when you are told that all repurchases are harmful for shareholders or to the country, or particularly beneficial to CEOs, you are listening to an economic illiterate. Okay, and this is Warren Buffett talking about repurchasing buyback program. Okay, buybacks are always good, and this is why we can see the buyback trend here on the forecaster terminal. Look at Microsoft, for example. They are repurchasing since ever. Okay, another interesting voice is the shareholder yield. Okay, if you are looking, for example, to a company, here we are on Microsoft, of course you have a dividend yield. This is the yield you get if you buy shares of the company, okay, just from the dividend. Of course, everything is explained. Shareholders yield is very interesting because you add to the dividend yield the net buyback yield and the debt pay down yield. It's very interesting because, especially if you're looking for a company for the long run, to invest in a company for the long run, you really understand, thanks to the shareholder yield, from where the dividend is coming from. Okay, because if you have a shareholder yield which is higher than the dividend yield, it means that the dividend you are getting from the company really is coming from good result. Because if you have, for example, a shareholder yield which is lower than the dividend yield, it means that the company probably is doing debt in order to pay you a dividend. And this is something that sometimes happens to companies, but it's something really bad because it means they are using your own money in order to pay to you a dividend. Okay, so this is a very important metric, the shareholder yield, because it tells us if the company is doing is paying for real is is a shareholder or not. Okay, here on the right we have the weighted financial, which are very interesting uh, numbers, because you have the sales compared to the number of shares, the net income compared to the number of shares, the free cash flow compared to the number of shares, and the gross profit. Like in this case, all these numbers are growing. It means that the company years by years is becoming more efficient. Okay, and this is a very important ratio. These are very important ratios because you really understand if the company is getting better year by year. Okay, avoid companies that has this ratio going down because it means they are not improving their efficiency. Okay, and of course here you have um, a, a resume of all these ratios. In this case, you have a shareholding yield which is decreasing. Okay, so it's not the best situation, but of course, you have go deeper to the analysis. Let's go, for example, here. Here we have a shareholder yield for Meta, which is increasing. Everything is good, and this is why the company is valuated robust. Okay. In the case of Microsoft, the company is resilient, which is of course good because he's here, is in green, so it's good. But robust, of course, it's better. Okay. The last, so in this case, guys, talking about NVIDIA or Microsoft, let's talk about NVIDIA, which is the example we would like to make. As I told you, first of all, we can see the under overvaluation. In this case, we have an undervaluation of 62%, which is very interesting. We have a company which is very solid, okay, with an Altman Z score of 54, incredible. Piotrowski score is good. Benichem score is minus 2.28, which is good. The company is doing great as per efficiency. Look how it's growing. And they also doing buybacks since 2022. Really nice, amazing company. Okay. Fundamentally speaking, we are talking about a company which is nice, which has an upside potential. And so we can definitely say we find also in the fundamental layer the same situation we saw in the overview, in the seasonality, in the overbought, oversold. Okay. Of course, you can deep dive inside the analysis. Uh, you can, as I told you, use the AI forecaster AI agent that give you a deep analysis of the income statement, the balance sheet, and everything. And this is very interesting also for the transcription because, as I told you, uh, at the moment there are many people inside the banks that are doing the analysis, especially young people, but in month or year, this kind of job will be something like the calculator. Today, everybody are using the calculator, and it's stupid not to use the calculator because, I mean, it would be stupid not to use it, okay? And the same is with the artificial intelligence. We teach how to use the artificial intelligence, how to do this kind of analysis to artificial intelligence, and it's better than us to make resume of papers and papers and papers, and this is very nice, and you can pick something interesting inside all these numbers and all this data in order to understand if the company has a very strong potential for the future. Talking about the transcription here, what is very important is this voice, risk and concern, okay, and future outlook. Here you can definitely see if something bad is in the eye of the management, okay? So always go to the transcript and watch and listen what the management is talking, is saying about the risk and concern and the future outlook. Very, very important. If you would like to do a complete analysis of every stock, it's very interesting to do the full analysis. And especially in this case, what is very interesting is the competitive advantage analysis. This is something that was invented by Warren Buffett, the moat analysis, okay? And the artificial intelligence in this case give you a rating for the moat that in the case of NVIDIA is 9 on 10, which is very high. And this is very interesting because the competitive advantage is telling us something really interesting about the company we are analyzing, and it's very important to understand what kind of company we are analyzing, okay? For example, I recently made a portfolio with only, I can show you, for example, on this very important law we just made on the market, I bought, thanks to the forecaster terminals, all the companies with a moat of 9 on 10. As you can see, we have Ferrari, ASML, LVMH, L'Oreal, Nvidia, Meta, Palantir. I bought it today because it's dropping, so I bought it just today. Meta, Microsoft, Adobe, Apple, and Visa. Okay, this is the Bitcoin, and this is another instrument that probably you even cannot buy because it's on the Italian stock market. Anyway, um, I'm so convinced that we are on a very important law that I took all the companies with a moat of 9 on 10, which is the highest number we can find. Look, for example, ASML, it's 9 on 10, okay? And I bought all the shares because I really think it's a great way to analyze the stock market, okay? Last layer, guys, is the politician. In the United States, you have politician must say if they invest in a specific stock, okay? So inside the forecaster terminal, we have the US Gov tracker, and we can see all the single trade every politician is doing, okay? We can track also a specific politician, okay? You can find the specific page with all the trades, okay? But we have also the layer for a specific stock. So for example, in this case, you can find all the trades for a specific, for NVIDIA. You can do it also for Meta. You can do it for all the American companies, the American shares, okay? And this is something interesting because sometimes it happens that some politician buy a specific sector, buy a specific company, and this could be really interesting in order to understand what is happening on the market. My honest opinion, I don't use it a lot, this tool, because watching the politician trades in the last 6 or 12 months, they are not so good. So I prefer to do my own analysis and not try to follow someone that I really don't know who is and why is buying or why is selling. Okay, but sometimes it's interesting because you can see if they are buying or selling, and it's nice. Look, for example, in the case of Nvidia, they bought a lot starting from 2023, and then they sold a lot here on the tops. So it's quite interesting to see, but in my opinion, it's not. It's interesting, but not so interesting. I don't know how to say, but I mean, I prefer to do my own analysis. Sean is asking me, how can I find the stocks with the highest moat in one go? You cannot right now, but we are working on screeners, and they will be soon available. Okay, we are improving the forecaster a lot, and this is something that you will definitely find as soon as possible. Okay. Something else to say regarding the stock analysis? I think we said everything. Of course, as I told you, you can go directly on the stock from the search bar, or, for example, you can find investment ideas from the tools you have here. And talking about the stocks, you can find, for example, the rankings. We talk about the rankings in the previous lesson, but for example, you have here all the indexes, you have here all the sectors, and you have here all the industries. Okay, for every layer. For example, let's go to the S&P 500. Let's say you would like to find, we talked about this feature in the previous lesson, because as you can see, you can find the over or undervaluation for the entire index. But if you are looking for opportunities, talking about the stocks, you can find the best opportunities here. For example, talking, if you are looking for the best company, fundamentally speaking, you can just on this button, and here you have a list of the companies with the best fundamentals. Okay, and this is something really, really interesting, because here you can find a, something like a screener with the best opportunities. Okay, and if you would like to deep dive in the analysis, of course you can open the specific page for the stock. In this case is Nike, and you can start with the overview, the seasonality, the overbought, oversold, the fundamentals, and the politician. Okay, and here you have, with thanks to this button, the best opportunity, fundamentally speaking. Okay, you can go to the ratio page, for example, where you can make a list with the best dividend yield company. Okay, for example, look, the first one, Dow Inc., has a very high dividend yield, but a shareholder yield of only 3.88, which is something that I don't like, because it means that the real dividend yield is 3.88, but the difference between this and this, probably they made loans in order to create this money. Probably they are printing shares. Of course, we have to deep dive better, but no, they are not printing shares. But look, something strange is happening on this company because has a moderate risk of bankruptcy, and somehow, let me see. Look, for example, they are increasing the debt years by years, probably because they would like to keep high the dividend. Look, from 0.75 debt equity in 2022, it became 0.85 in 2023. It became 0.96 in 2024. As I told you, probably they are raising the dividend yield in order to attract the investor, but the reality is that the investor are paying by themselves for this very high dividend yield, okay, which is a countersense. I mean, you can go here to the ranking page. Where is it? The ranking page, and you can create all the list you want in order to find the company to analyze. Something very interesting also, you can rank the stocks for a specific index, for a specific sector, for a specific industry, also for the stock performance. And this is something really interesting because you can find really nice opportunity watching, for example, which are the best performance of the last week, which are the best performance of the last month. I mean, this is a tool, the ranking, that allow you to screen an entire market, an entire sector, an entire industry just in a fingertips. Okay, for example, you are interested in as I am in the luxury sector, the luxury industry in the consumer cyclical sector. Here you have, for example, you can find just in a very a very few seconds which are the best company fundamentally speaking inside this specific sector, this specific industry. Okay, and of course you can find a lot of opportunities inside. Another tool you can use in order to find the good opportunities for an investment, for investing, is the break even. The break even is a very nice tool because do something really easy. Every time a company for the first time is closing a positive quarter, you will have the company in this list. So, for example, recently we can see Twilio, which is a very interesting company, released the earnings, and as you can see, this is a company which in the past always lost money. Okay, why it's now in this list? Very simple, because we have a positive quarter for the first time. This is something very interesting because if you go here to the explanation of this section, as you can see, we have many examples of companies that after the first quarter in profit, they started to skyrocket. Palantir is one of the example, one of the most famous example, but also Tesla started to skyrocket in 2018 after the first quarter in profit. Okay, and Twilio, for example, right now is exactly in this situation. What we can do, of course, we can analyze the company. Don't You can not have a look to this part when you are talking about a company that lost a lot of money for many years. It's difficult to find an undervalued company. Look, for example, the discounted cash flow, the Peter Lynch method is not applicable because it doesn't work with the company that lost a lot of money in the past. But for example, Twilio is very interesting company because as an Alt 1 Z score of 472, it means the company has a solid situation. Okay. Also, the Piotrowski is in a very good momentum. The Banish score tell us that the company is unlikely to be manipulating its earning. And look, what is very interesting, the company just started a buyback program. Okay. The management think that the company is undervalued and they repurchase their own shares. Very, very, very interesting. They also have a positive earning yield. The weighted financial are increasing. It means the company is becoming more efficient. Okay. And if you analyze, thanks to the AI, the transcription of the last quarter, you can definitely see a very interesting potential for the future. Okay. Because they have a very interesting future outlook and they are investing a lot in AI for their product and services. Okay. And this is why, for example, I bought the company because also the overbought and oversold page is telling us that we are very close to a major turning point, probably. This is very interesting. The last tool I would like to show you in order to find opportunities on the market is the quantum screener. Of course, today we are talking about shares, so you can definitely go here and search on the S&P 500. This tool is very nice, especially if you are looking for trading opportunities. Very simple. The tool is telling you, for example, that Accenture right now, the price of Accenture has a 94% correlation with the 3-year seasonality. Okay. Very simple. You can open this page and you can see what you can expect from this share. Okay. You know that the current year is moving exactly like the prices did in the last 3 years on average. Okay. So you can expect a 7.8% starting from today, from tomorrow until the very beginning of August. Okay. And this is something amazing because you can find on the S&P 500 shares, the MSCI World, or the stocks Europe 600, the best opportunities starting from tomorrow. Okay, as you can see, these statistics start from tomorrow, and you have the best opportunities. And of course, you can evaluate to do a trade on these companies based, in this case, completely on seasonality. Okay. Of course, we already saw the seasonality, and this is very interesting because you have all the statistics and you can definitely see if you have an upside potential. And this is a tool a lot of people are using a lot because it's very powerful. It's inspired by Jim Simons, and we really use it a lot because you can also, let's say, play with this tool, because in this case, for example, you can see the statistics regarding um, regarding 3 month, because here you can choose 1 month, 3 month, or 6 month. Okay. But in this case, we are on 3 month, and then of course you can play. You can say, but why do I have to close this trade in August where if I can go on until November? And of course, you can have all the statistics. And if you would like to see when the overbought and oversold, you can definitely see. And in this case, as you can see, it's very interesting because look, here we had a very important low with the indicator, the market mood meter that told us that we were in a panic selling mode. Then prices went down, but the indicator gave us a divergence. And here we have the confirmation the trend has changed because the prices crossed the zero line. Okay. So in this case, we can definitely say, yes, seasonality is telling us that we have an opportunity, and we put another pair of lens, another lens, and we do another kind of analysis. And as you can see, the overbought and oversold is saying that we have an opportunity, an upside opportunity. Of course, we can go to see the fundamental if we would like to be more confident with the analysis. And look, we find a company which is undervalued, which is growing, which has no risk of bankruptcy, which is doing a repurchasing program, a buyback program, which is nice. So we can be more confident in go long on this stock. We saw all the tool related to shares, and that's it, guys. I hope you enjoyed this lesson regarding the stocks. See you next week because we will talk about commodities. Okay, so see you next week. Hope you enjoyed. And that's it. I'm a little bit tired. See you next week. Bye bye. Ciao, ciao. Today we will continue our masterclass regarding the forecaster terminal. This is the third lessons, and today we will have a deep dive into the commodities. So let me share my screen and let's start with the lesson of today. Tanti saluti dalla Germania is saying Sven. Thank you very much, Sven. If you are not Italian, tanti saluti dalla Germania, it means greetings from Germany. Thank you very much. Hi, everybody. So, first of all, as you probably know, as always, let me remind you that the Forecaster terminal is built like Google. So, as you can see in Google, you have a search bar where you can find direct what you are looking for, and you can go to the tools you have here in your workspace. Exactly like Forecaster, you can search a financial instrument directly, or you can go here where you have all your tools and you can get ideas from our tools. As I told you today, we focus on commodities, okay? And let's start with the most famous commodity in the world, which is the gold future, okay? As always, if you have any question, feel free to write in the chat. Thank you, Vasim. Thank you, Todd. Thank you, Ali, Anil. You are so many today, so I'm really happy to see you in the chat. So, as always, the forecaster is built to have different kind of analysis on a single instrument. So, for example, now we are on gold, okay, because we search directly for gold here, and gold is one of the suggestions that we have from the software when we dial when we start to search something in the search bar, okay? So, as for every others instrument, we have an overview page, very easy overview page where we can see the performance for this instrument all across the time frame. So we have 10 years, 20 years, 5 years, and blah, blah, blah. Okay. And here we have the single year performance. Okay, this is a very nice page. It's very interesting because we can get a big picture idea, okay, of what happened in the past. Okay, the second layer is the seasonality, and in this case, talking about the commodity is something really interesting, because commodity, as you can imagine, tend to have a very strong seasonality. Okay, so for example, here we are on the gold, and starting analyzing the seasonality, we can definitely see, for example, this is the today date, okay? And as always, we can add, for example, the current price. We can add different kind of seasonality, for example, last year, 3 year, 5 year, and we can go back until, for the gold, 30 years, okay? What does it mean? Very simple. For example, let's concentrate, for example, on the 10-year seasonality. So it will be much easier to understand if you approach the seasonality for the first time. Okay, here we are. What you're looking at in pink, it's the current year. It's how the gold is moving right now. What you are watching here in, let's say, red, it's the 10-year seasonality. It means that we take prices for gold starting from the 1st of January until the end of December for the years 2024, 2025, 2023, 22, 21, 20, 19, 18, 17, 16, and 15, 10 years, and we do the average, okay? Doing the average, we can definitely understand and see on the chart if in a specific period of the year we have a specific trend, okay? And of course, this is something we already used for the indexes in the first lesson of the master. This is something we used for stocks in the second lesson of the masterclass, and today we will use it for gold, for commodities, and of course you can use for all the instrument we will see during this masterclass. Okay, this is something very interesting because, of course, if in a specific period of the year we have a specific pattern, of course, it means in general, okay, in this period we are watching, we can experience that kind of trend, okay? I always do the example with the temperature. If we write on Google, New York City, temperature, okay, and we go here, as you, here we are. This is a chart where we can see the average temperature for New York City, okay? As you can see, this is a very nice example of seasonality. We can actually go also to our website where we have a very nice description of seasonality. Here we are, and we have the same chart, okay? So we can definitely switch to our website and not to this random website regarding New York City I found on the internet, okay? And as you can see, talking about temperature, which is a very nice example of seasonality, okay, we can definitely say that during January we have a temperature, a medium temperature in New York City, which is below zero. We can definitely say that in July we have a medium, an average temperature of more than 24 degrees, okay? And of course, what does it mean? It means that this is an average temperature, okay? That goes from below 0 to more than 24 during summer, okay? It means that we can expect this temperature, but of course, during the year, we will also have drops, okay, of the temperature. But in general, if we have a pattern, temperature will go back to the average, okay? And this is something that or happen also on the stock market, okay? And in general, also with commodities, okay? And this is something very interesting because thanks to the forecaster terminal, we can see on the chart if we have a pattern, but we can also highlight on the chart a specific period, and going a little bit down in the page, we can see which are the statistics. So for example, in this case, we highlighted from, let's say, today until the very beginning of August. And here we can find all the statistics. In this case, if in the past 10 years we have been long, 50% of time we had a profit with an average return of 9.8%. Okay? And here you have all the different years in the same period, as you can see, with the specific statistic for the single year. Okay? And this is very interesting because we can definitely understand if a specific period of time it's more bullish or bearish. In this case, for example, we have only 50% of odd to have a long period, okay? If we switch to short, we can see something very interesting. Of course, if we made in the past a short trade exactly in this period, of course, the winning percent remain 50 because 50 is 50. So even if you are long or short, you have the same winning average. But in this case, something really interesting happened because look, the average return for a short trade in the past 10 years in this specific period, look, this is the average return, 4.2. So we can understand that compared to the long, where we have a 9.8, this specific period we are approaching, okay, is more bullish than bearish, okay? And this is something really interesting. Here in the seasonality, we also have the correlation, okay? This is a very interesting data because thanks to the Pearson formula, okay, we calculate how the actual price, how the current year is moving compared to the seasonality, okay? As always, everything is explained here. Every time you find an info box, if you click, you find a complete explanation, okay? Correlation show how two things move together. If they are positively correlated, when one goes up, the other usually goes up too. We use the Pearson formula to measure this relationship between the current price and different seasonal patterns. Okay? It tells us how closely changes in one thing match changes in another, and it calculates over 60 business days. Okay? Pearson formula, of course, if you would like to search, you can find everything online. If you would like to go deeper inside the formula, there is also a Wikipedia page, so you can have all the information you want. Very simple. We know, for example, with an 87% of correlation between the current year and the 10-year seasonality, that we have an high correlation. It means they are moving very similar, because out of 100 days, 87 are moving exactly like in the past. Okay, let me see if we have Anil. This formula is taking me back to the university days. Nice. Yes, exactly. What we do with the forecaster is just taking what you can learn at the economic university, and we plot it here in our software with a very nice user interface. That's it. We don't want to how can I say, we don't want to invent nothing. This is not a black box. We don't want to tell you what to buy and what to sell. We would like to give you the data, the datas you can use in order to take your decisions, okay, regarding trading and investing. Of course, what is very nice also regarding the seasonality, at the moment, as I told you, we are watching the 10-year seasonality, but of course you can do these um, these analysis also going back, for example, to 20 years. Look, for example, 20 years is very interesting because we have a very high correlation. Okay, we have a 91% correlation. Okay, and it's very interesting to see, for example, on 20 years, the average winning goes up to 60%, which is very, very nice. Okay. Anyway, let's go back to 10 years just in order to keep the analysis very simple. But as I told you, you have also the daily average, very interesting, because, for example, in the past 10 years, you can see that today, which is the 13th of May, 71% of this specific day were long. And of course, you can find really interesting statistic, because look, for example, the day 20 of this month was 86 long, and the day 21 was 100% short. Okay, so lot of people that are using the forecaster, for example, for intraday trading, they use these statistics in a very nice way. For example, they wait until the 20 of the month, okay, on the gold, and they wait until the very end moment of the day, and they place a short, okay, because the odds for a short day for the day after, which is the 21, are very high. Okay, and of course, i leave to your imagination all the ways you can use this data, and it's very, very, very nice. Okay, of course, you can also find the weekly average with the single days. Okay, so for example, here we highlighted a specific period, and here you can find the odds for every single day: Monday, Tuesday, Wednesday, and Friday. Okay, and also the monthly average. So for example, as you can see, September, for example, in the last 10 years was a really bad month for gold. And as I told you, you can also add other seasonality. Okay, so if you would like to have the same statistics for the last 20 years, look, here we are. For example, the 21 of May is a very bad day for gold. Look, because both in 10 and 15 years, we had 100% of short, which is an amazing statistic. Okay, and also here, as you can see, we have a consistency. Look, June is 70% in the last 10 years, 67 and 65. I mean, it's very consistent, this data. Look, September, very bad month, 90% short in the last 10 years, 80% short in the last 15, 65% in the last 20. If we go here, look, the 21 is 100% short also in the last 15. Very nice data. Harry, Harry is asking me 25 years of seasonality show 92% of correlation. Should we use this? Of course. For example, what I always do using seasonality for commodities, but also for all the other instruments, I, in general, plot all the seasonalities, okay, and I watch which is the seasonality with the highest correlation. So in this case, for example, we have 92% correlation with the 25 years, okay? Nice. If I would like to use it, it's good to use it because I know that compared to the actual price, to the current year, okay, it's the one which has the highest correlation. So I know that if this correlation continue to stay so high, okay, if will tend to stay high, it means that the prices will probably move as what they did in the last 25 years. Okay, so for example, watching at this chart, I can see a very high correlation. So I can definitely highlight, for example, this period where on the chart, but we can also do here, look, on this chart, I can see there is a bullish trend, okay? And I can go and see the statistics. In this case, okay, we can also do a little bit more so we have more reliable statistics, okay? Starting from today until the end of September, look, in the last 25 years, we had 64% of winning. It means out of 25 years, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, and 16 year of positive returns with an average of 8.7. Look, if you would like to understand if in a specific period you have a high consistency results, you have to try also the short. In this case, both the winning percent and the average return are higher compared to the short, because here we have only 36 with a 6.8% return, okay? It means in this specific period, a bullish trend is more probable, okay? Here we also have the correlation. So we also know that out of 100 days, 92 days are moving exactly like they did in the last 25 years on average. So this is exactly what we can expect from gold in the next month. So as I told you, the forecaster term, you can use the forecaster terminal in many ways, but actually this is a very nice method to use it, okay? Because we know that historically speaking, gold moved I mean, we know, for example, using I don't like to use very long seasonalities. In general, I use just in order to understand which is the seasonality for a specific instrument. I use something between 10 and 20, okay? Just for understanding how this specific instrument did in the past, okay? For example, June, it was historically speaking a bad month for gold. September, historically speaking, was a bad month for gold. But we added the correlation, okay, because what happened in the past is not a promise for the future, okay? So we added the correlation in order to understand if today we can rely on seasonality. And in this case, of course, we can also use the 25-year seasonality because has a very high correlation with the current year. But as you can see, the analysis for the next month is very consistency, because we have a high correlation on every seasonality, okay? And of course, we can expect a result between 8.8% and 6.9%, okay? So on average, let me say, we can expect for the next month a upward movement for the gold of something bit near 8%, okay? And in this case, we combine seasonality and correlation, because of course seasonality tell us what a specific commodity did in the past, but thanks to the correlation we can understand if we can expect it also in the future, okay? And this is something amazing and important. Of course, we have also the overbought and oversold layer, okay? And we already talked about this indicator in the previous lessons of the masterclass. So I will go very fast with this lesson. Okay, here we have this indicator, which is inspired by the CNN fear and greed index. The difference between the fear and greed index and this indicator is very simple. We calculate this indicator on every financial instrument, including commodity. The CNN fear and greed index is very nice. As I told you, we have been inspired by this one, okay? But you can use it only for the S&P 500 and stock market in general. We created this indicator thanks to statistic, thanks to, here you have all the explanation, okay? But is a mix of the advanced DPO, the Wyckoff, and the speed, which are the other indicator you can find on this page, okay? As you can see, thanks to this indicator, we can find overbought and oversold moment on the chart. And of course, when we are in oversold, which we also call panic selling, we are in a buy area. When we are on oversold, overbought, which we also call FOMO, fear of missing out, we are close to a potential top, okay? For example, in this case, how can we interpret this indicator? Very simple. We are exactly in the middle, okay? So it's a signal that we can expect what the seasonality is telling to us, because as you can see, the indicator is rebounding, is jumping on the zero line, which is something that happened also in the past, okay? So in this case, we know that the seasonality is bullish, okay? So this is something like a bullish signal from the indicator, okay? Because we are not on the extreme part of the indicator. We are not in overbought, we are not in FOMO, we are not in oversold, we are not in panic selling, we are just neutral. So we actually don't have any buy or sell indication. we have, let's say, an old indication, and so we can rely on seasonality. Of course, the last layer for the commodities is the COT report. If you don't know what COT report is, very simple. We can go here to the CFTC Commission website, the Commodity Future and Trading Commission. The COT report is a very interesting report that this commission publish every week to help the public understand market dynamics. Okay, so it's something you have available only for futures, listed future at the CME, okay, which is a stock exchange, and you can find this report. Oh, sorry, I closed the page. You can find this report here. This is for example, as you can see, palladium. We have also the copper. We have cobalt. We have lithium, aluminium. Let me see, steel, and all the commodities. Look here, we have the gold. Okay, and this report is telling us if, for example, how many long and short position, for example, managed money has in this specific moment. Okay, of course, this report is terrible because it's very difficult to understand something inside all these numbers. What we do on Forecaster is very simple. We take all the historical data and we plot on the chart together with the gold in this case, but we have this chart for every commodity, all the position for every single category we have on the COT report. So we have, for example, the managed money. We are talking about the hedge funds. We have the producer, merchant, and processor, which are, of course, the producer of gold. Okay. And by default, you can find the net position, which is the long position minus the short position. Okay. In order to analyze the chart, you can definitely use the net position. Okay. What we can see, it's something really interesting because we know, for example, that right now, during the last bullish movement of the gold, the managed money, we are talking about the hedge fund, closed a lot of long positions. Okay. And you can understand what they are doing with their position regarding a specific commodity. And this is amazing, guys, because we can definitely understand many things regarding the potential future, the potential movement in the future for a specific commodity. Okay. For example, what we are looking for are, as always, divergence. When we find the divergence between the net position and the prices of a specific commodity, we can definitely say we have an opportunity. Okay. If, for example, we find a divergence and both the oversold and overbought and oversold is telling us, for example, to go long. The seasonality is telling us to go long, and the institutional investor are betting long. I mean, our odds are very strong for a long trade. On the gold, we have a divergence because, as you are saying, as you wrote in the chat, if the managed money was selling their position in gold and the price was going up, isn't this a bearish divergence? Did I misunderstand something? No, exactly, correct. So for example, talking about gold right now, we have a bullish prediction thanks to seasonality. We have an old indication from the overbought and oversold page. Actually, we don't have a buy or sell signal, so we don't have an indication. And thanks to the quote, at the moment, we have a divergence. Yes, of course, you are right. Will I bet short on the gold because only of the quote? No. And this is why I created the Forecaster terminal, because I would like to bet, I would like to invest, I would like to trade only when my odds are on my side. And in this case, only the quote report is telling me that I have a divergence. But this is not a selling signal. This is just a divergence. It will turn in a selling signal only if prices will be in an overbought situation and I expect a downward movement from the seasonality. Okay, is it clear for you? Perfect. Thank you very much, Scott. Perfect. So as I told you, the COT report is very interesting because we have this voice: producer, merchant, and processor. Okay, this is a very interesting voice regarding the commodities, because these guys are the ones are really producing the commodity we are talking about. Okay, these are the guys that take out the gold from the ground. Okay, so they know everything about the gold. They know exactly how much it costs for to them to extract this commodity from the ground. They exactly know how many orders they have. They exactly know everything about the commodity. Okay, and I don't know why nobody across the globe are using this data, which is very, very interesting, because now I will show you something amazing regarding this data. Okay, because look, I can show you to let you understand something on the natural gas. Look, let's go here. We can go to, let me see, natural gas. Look, first of all, producers use the futures in order to protect themselves from price volatility. Okay, follow me, because this is very interesting. Futures, they was born to let this exactly category of people to sell in advance their product. Okay, so for example, to keep it very simple, okay, this is the factory that produce the natural gas. They take the natural gas from the ground and they put it in a big tanker. Okay, sorry, I'm not an artist, but try to imagine this is a tank with inside the natural gas. Okay, starting from this moment, which is the day one, let's say, until the day they will get the money from this natural gas, that could be, let's say, 60 days later, 60 days, okay, I'm sorry for my paintings, they are terrible, I know, but anyway, you got the point. One day, okay, after 60 days, they get the money, okay. Producer has a very big problem during these 60 days because the price of natural gas will move during these 60 days. So, for example, if they sell today the natural gas to someone that, if they extract the natural gas today, okay, and they will sell it in 60 days, maybe can happen that the prices fall down, okay, in these 60 days, okay? This is why the future market exists, because it allows to producers to short future contract, and very simple, if they short, it's like they are freezing, okay, their deal, okay, because if they are short and during these 60 days the price will fall, okay, they will gain a lot of money thanks to their short position on the future market, okay. Of course, they don't care if the price will go up or down because they are covered by the future, okay. If the price follow, they will make money thanks to the short position. If prices will go up, they will make more money thanks to their natural gas, the real one they are selling, but of course, they will lose money on the short position. So actually, what they are doing, what producers are doing, thanks to the futures, is just freezing the position. They doesn't care. They don't want to. They sell gas. They sell natural gas. They sell a commodity. They don't want to speculate. Okay? Is it clear, guys? This is very important. Thank you, Sven. Sven wrote, I like your art a lot. I don't know why, but if you like it, I'm happy. Okay. They equalize the price, is writing Anil. Okay, perfect. They lock in their sales price, Scott wrote in the chat. Exactly. Perfect. So you understood. But what happened? Everybody would like to make money. And this specific category of people knows everything about the price of the commodity they are selling. Okay. So sometimes something really interesting happen with the net position of these guys. Look, sometimes they see the opportunity to put themselves in a long trade. And guys, this is something that is happening right now. This is why I'm showing you the natural gas. Because look what happened. Sometimes they said, hey guys, why don't we use the future market in order to make a bet? Because we know we have many orders. We know the price is very low because we know everything about this commodity. Why don't we place a bet? And sometimes they do. And in general, when their net position is long, we are very, very close to a very important law. And this is something you have to watch for every commodity, guys, because these are the smart money in this market because they produce the commodity. They knows everything. They they see the orders coming, okay? And this is exactly what is happening right now with the natural gas. Of course, Anil wrote in the chat, they have inside information from other competitors too. Of course, guys, we are talking about commodities. In this case, countries buy natural gas. Okay, we have all the information regarding this. And of course, it's something that happen not so often, but it happened. And of course, we have many commodity to watch. Okay, but this is something amazing. Okay, because for example, right now you can see their net position are long, very very nice. Okay, something similar happened with the sugar. Anil is saying, of course, of course. If you go here up in the page and you go to COT report and you go, for example, here on sugar, okay, look, this is a pattern that occur all the time. And of course, you can use it also for the opposite part, because when they are shorting a lot, it means they are really scared about the price, okay? And of course, when prices are very high for a specific commodities, they tend to be very short, okay? So, for example, right now, the same situation we have on the natural gas, we have on the sugar. I mean, we can definitely see producers are not betting anymore for the short side, so they are not scared about losing because the price of sugar go down. Okay, and this is the best bullish signal you can see in the commodity market. Of course, we can also find good signals and good divergence with the managed money and on commercial, which are actually the same. Okay, but this is game changing, guys, and this is something that I don't know why nobody are talking about all across the globe. I watch all the financial analyst video all across the globe and nobody's talking about this. I don't know why actually. Sugar is asking Sven, if you look at 1 year chart of producers, is that a divergency? Look, in the case in this case, yes. Look, here we have a divergency because look, here we have volumes, the net volume that are going up, and here we have a chart which is going down and made a lower low. You can also switch to line if you prefer. Maybe I really love this kind of chart with bars. I love it. But some people in my organization said, look, it's better to have the line chart. And of course, we plot it also this one. But I prefer this one. Yes, this is a divergency. And this is a very strong divergency because it's made by producer, merchant, and processors. Okay? Let's go to have a look to some very cool examples, okay? On the rice, which is a market, to be complete honest with you, I don't trade, okay? But it exists. Look, very interesting situation because we have prices which are very low with the institutional which are very long. Sorry, the producer which are very long. Look, and this is something that happened also in the past. Very, very nice and very interesting. Okay, really nice. Do you like this producer and merchant trick? I love it. I mean, you can definitely understand something really deeply thanks to the producer, because of course they are there to make money. If they see the opportunity to make an extra profit thanks to future market, I mean, look, very simple. What you see right now are the net position. Look, by default, on every chart you see net position. When you have a chart like here, which is below the line, it means that the net position is short. Okay? And as you can see here, prices of sugar were very high. And of course, they was short because thanks to the short positions, they freeze their deals, okay? As we said before. When the net position switch on the upper side, it means the net position are long. The net position are the long position. As you can see here, we are only on the upper part, minus the short position. As you can see, for example, in this case, since the beginning of 2024, this category, the producer, are closing down their short position. Here we are on the short position, okay? They are just closing down their short position because they think they can make an extra gain, they can make extra money thanks to the rising rice price, okay? Look, and they are also closing a little bit the long position, look, okay? Just a little bit, but they are definitely long. And look, the result is a net position which is very bullish. How long do you take a future contract for when you do these trades? I tried trading future 20 years ago. I did not look the whole overnight position. Look, for example, as I told you, I don't do the rice. I do the gold, I do the natural gas, but I use, for example, different instrument. For example, I go for the CFDs. I go with the mini futures and this kind of thing. You can also use, for example, the ETF. I mean, you can use the instrument you want. What you have to learn to do is the analysis in order to understand if the price will go up or down. That's it. Okay. Some other example. Here we have an example on the gasoline. Look, for example, here, we can definitely see a very nice recurring pattern. Look, starting from July until the very beginning of December, on the seasonality, here we are back on seasonality, we can see a specific pattern. In this case, as you can see, both on 3, 5, 10, 15, 20, 25, and 30-year seasonality, we can see the same pattern. It means that, historically speaking, in this specific period, we have a very nice trend, okay? Look how powerful in this case is the seasonality. This is an instrument that really tend to repeat himself very perfectly. Yes, of course, Earl is saying it's interesting inside, but often it takes a long time to see a price reaction for the future positions. How Could a person better time the market with this future data? Very simple, guys. Very, very simple. You can use you can do an analysis where you go also with the COT report, but then you can time the market thanks to seasonality and overbought, oversold. Also on sugar, it's very nice, for example, because look, we saw on sugar that the producer and merchant are turning long, which is a bullish signal. And look, for example, here we are in a moment where the seasonality is telling us with a very high correlation with the current year that prices has a very bullish period in front of us. Because look, both in 7, 10, 15, and 30 year, we have a winning percent, which is on our side, with an average return of 21, 23, 28, 29. Okay, these are very good statistics, for example. Okay, and in this case, this is a way to time the market thanks to seasonality. Okay, we know we are in a very bullish window, and also we can go to the overbought and oversold page where we can see, for example, that the market mood meter just turned bullish. Okay, it just went to the lower part of the indicator, the band where we can experience very important lows, and now it's turning because, as you can see here we are in a neutral position, but we can definitely say we are on a very important low. Okay, if you see an historical, a much longer period, look, we are definitely on a very important low. And in the case of sugar right now, all the different analyses you can do with the forecaster, seasonality, overbought and oversold, COT report, tell us that the sugar has to go up. So in this case, we have very strong odds in terms of, we have a very strong odds related to a bullish period. Pierre, why is the correlation so low on RBOB seasonality? Doesn't match with the charts? Easy, because the price, the actual price, is not moving as the historical prices. That's it. Very simple. Very simple. Look, at the moment, okay, look, we are right now in May. If this is a very nice example, thank you very much, because I would like to show you something. Because, for example, here we can find all the correlations are very low, especially the 15 years, which is the lowest correlation with the 19%. Okay, so let's isolate only the 15 year, because when you find such a very low seasonality, a very low correlation, it means something really interesting. It means that probably the prices will do the opposite. Okay, because if we have a very low correlation, like in this case, what does it mean? 19%. It means that out of 100 days, only 19 are doing like the historical seasonality we have on the chart. It means they are doing the opposite. If with the trend, the chart, we can definitely see that at the moment gasoline, okay, is moving exactly opposite to what it happened in the past. Look, here we have a top, here we have a low, here we have a top, here we have a low. Okay, so in this case, here we have a top, here we have a low. In this case, we can really expect for the gasoline price that will move the opposite for compared to the seasonality. So for example, in this case, historically speaking, we have a potential short period, because look, in the last 15 years on average, in the last 15 years, 73% have been short years in this specific period with an average return of 13%. If we had a long, we had a profit only in the 26% of cases with an average return which is lower than the short. Okay, so this time period, this time window, historically speaking, was short, but nowadays, right now, prices are moving exactly the opposite, so we can expect the opposite. Okay, let's have a look to the producers. Also in this case, the producers has never been so bullish like they are right now. Okay, look, they just been a little bit more bullish here in 2024 when the gasoline did the most important low. Okay, so we can expect higher prices for the gasoline because the producers are betting long, and seasonality is telling us that despite the bearish time window we have in front of us, the actual prices are moving complete to the opposite side. Something very important related to the commodities. Of course, you can find many, okay, because we have agriculture, we have metals, we have the petroleum, the natural gas. Something really interesting, if you like to trade, you can go to the quantum screener where you can find and you can isolate only the commodities. In this case, for example, if you would like to choose a 3-month trade, but you can choose 1, 3, 6, okay? Here you can find which are the best correlation for the commodities. So for example, in this case, look, on the lean hog futures, okay, we know that the actual price has an 89 correlation with the 20-year seasonality. If you click here, you can click the page, and the forecaster opens a page where you can find the current year with the 20-year seasonality. And here you can find something interesting, because look, we know that for this specific commodity, for the next 3 months, for example, look, we have a 95% odds with an average return of 15%. And the quantum screener, which is inspired by Jim Simon's strategy, give you in 0 seconds all the best opportunity on the market. Okay, very, very nice. You can also find the worst correlations that we know, because I told you that we can use for the opposite side. Okay, but we can also find here, as you can see, we can find on sugar, we can find on gold, which is what we found before. If you click to best to worst, you can find the balance between the best correlation and also the win rate. Thank you very much. I just ask you a favor before to say goodbye. If you go to Google and you write Forecaster.biz, you can find the review page. If you please can write us a review, I really thank you very much, because we really need it in order to go abroad. At the moment, we are with the forecaster very strong in Italy, as you can understand from my accent. But we are really trying to go abroad. And for example, at the moment, a lot of people are using the software also from the States, from the Saudi Arabia, and also in Africa and in Australia. But of course, we are still very little abroad. So please leave us a review. Of course, 5 stars will be very appreciated. And if you have not 1 minute, but 2 minutes, if you go to Trustpilot, here we are. If you leave a review also here, you are very welcome, because it's very important for us. I leave you the link also for this one. If you help me with these reviews, I will be very happy, and I can continue to to share my knowledge, let's say, with you for free, of course. And that's it. We are really trying to do something great. We really love our software. I know you love our software. If you can please write us a review, I will be more than happy. And that's it, guys. See you next week with another lesson for the masterclass, and we will go deeply on other or something else. You can go also here, look on the Forecaster Terminal web page, and you can go here in tutorials, and you can find the previous lessons. Okay, you can find both the article and the video. Welcome to the 4th lesson of our masterclass. Today, we will deep dive in a very interesting topic, which is the COT report. Okay? COT report that we have here on the forecaster. You can reach the page COT report just clicking here on the top right of the page, where you can find all the forecaster tool. You can also find the COT report. Okay, what is COT report? Very simple. Here we are. You can find, as always, the description inside directly the forecaster terminal. The Commodity Future Trading Commission publish the commitments of traders, COT report, to help the public understand the market dynamics. Specifically, the COT reports provide a breakdown of each Tuesday open interest for future and option or on future market, in which 20 or more traders hold the position equal to or above the reporting levels established by the CFTC Commission. We can also go here to the commodity CFTC website, the Commodity Future and Trading Commission, and as you can see, you can find the commitments of traders, and here you find everything you need to know about this report. As you can see, the report help the public understand market dynamics, so this is something really interesting. And what we can find inside the COT report, we can just scroll down a little bit the page, and we can open, for example, the latest COT report regarding the financial futures. And here we are. For example, regarding the Canadian dollar, which is a future listed at the Chicago Mercantile Exchange, okay, we can find all the long and short positions for different categories and different participants at the market. So for example, we can find the asset manager and the institutional, the leverage at the fund. We are talking about the hedge fund in this case. And this is something really interesting because you can definitely understand how these special kind of categories are moving on a market, and this is something that can really give us an idea of what they are doing and how they are betting, let's say, on the market. We can definitely understand if they are long, if they are short, if they are changing their behavior on the market. And this is something really interesting because they invest and they trade the market professionally. As you can see, this is a picture of a specific moment. So, for example, in this case, you have exactly the situation with the long and short positions regarding May 13 of 2025. Okay, so this is exactly a picture of a specific moment. If you go to the Commodity Future and Trading Commission website and you go here on the let me see, historical data, for example, as you can see, you can find all the database that goes back until 2006, and you can find all these data that is published every week, okay, and you can have all this information. What we do here at Forecaster is something really nice because we go back in history, okay, and for every future available on the market, we take all this data. Let's go, for example, for the British pound, okay, we go on the CFTC Commission website, we collect all the data and we create charts. And we create charts that are much more easy to analyze and to interpret. Okay. And today I will tell you everything I know regarding the COT report and how to use it in order to invest and trade the markets. Okay. So, as you can see, the futures available are a lot because we have currencies, we have the agriculture, for example, where cocoa, coffee, and corn are. We have metals, we have stock indexes, which are very, very important. We have petroleum, treasury, and rates, and of course, the natural gas. We did something really nice because here at Forecaster, we created what we call the synthetic code. Okay. As you can see here, the code report, these code reports aren't official. They are generated by merging official contracts. Okay. So for example, we created a synthetic code report for the Australian dollars versus the Canadian dollar. Okay. So if we open, for example, as you can see, we have exactly the COT report, even if this is not a future you can trade on the market. What we did is something really interesting. For example, for Australian dollar versus the Canadian dollar, we just did something very interesting. We went to the COT report regarding the Australian dollar, okay, and we took all the data we went to the Canadian dollar future and we took all the data regarding the Canadian dollar future COT report, and we merged all this data, and what we had is what we call synthetic. And this is something really interesting you cannot find anywhere else in the world, and you can use it in order to analyze also these markets and these forex pairs where the future doesn't exist. Okay, and this is something really interesting and really amazing. But let's start with one of the most important COT report ever, which is the COT report on the S&P 500. Okay, in general, when you try to learn something regarding the COT report, analysts all across the world tell you that you can use the COT report in order to understand how the speculative funds are doing are trading on the market, and you can copy them. Okay, but this is not the right way to use the COT report, in my opinion, because, for example, nobody use when we talk about the S&P 500, but we can also see the Nasdaq 100, and we can also see the Dow Jones Industrial. Okay, but let's start from the S&P 500. What nobody is watching are the asset manager. And I really think when we talk about indexes, that this is the category of investors that we really need to watch if we would like to understand how the market will move. Okay, because these guys you can find inside this category pension fund, insurance company, mutual funds, okay? And this kind of asset manager that are really watching and they really invest for the long run, I really think they are the smartest investor we can find out there, okay? So for example, what we have to search in order to understand how the market will move are divergence. Like we always do, what we have to do is looking for divergence. Okay, here you have the COT report layer on the forecaster terminal. Here you have by default the net positions. It means we net the long and the short position, and what we obtain is the net position, of course. So for example, in this case, you can understand that the net position for the asset managers are always long because they use the future market in order to bet on the market. Okay, and as I told you, what we have to watch, what we have to search for are divergence. Okay, you can also use a different kind of chart. You can use the bar chart or the line chart. And for example, how we can use it? Very simple. Look, I show you something really interesting. We can use the line chart. Okay, remember, you can use your chat so you can write directly to me. Okay, Tufik, I always get confused when I use the COT report. I don't know which tab is relevant to read. Okay, you have many tabs, as you can see, because you have the commercial, non-commercial, dealer, asset manager, leveraged fund, other reportability, other reportables, total reportables. Look, very simple. The important voices are the non-commercial. We are talking about the hedge fund, the speculative funds, okay, and the asset managers, okay. You can forget all the other ones when you talk about the indexes, because the important one are those one, asset managers and non-commercial. Non-commercial are more speculative. We are talking about hedge fund, and they try to guess the direction of the market both on the long and short side. Asset manager are here for the long term, are the pension fund, the insurance, and they are investing long only for the long run. And as I told you, um, this category is really interesting and important because you can really understand what is going on the market. Okay, look, for example, watching the past 5 years, what you can see, the red line is the net position for the asset managers, okay? And look, for example, here what happened from between the mid of 2021, the market, the S&P 500, which is the blue line, was growing up, okay? And we had a top. Let me change the color so it will be more precise. We had a top here at the very beginning of 2022, okay? Now, have a look to what happened during this exactly period where prices for the S&P were going up. Look what happened to the net position for the asset manager. They started to realize that the market was in an overbought condition, was a little bit overvalued exactly here at the beginning of 2021, and they started to reduce their position, okay, on the S&P 500 until the mid of 2022. Look, here they started to reduce the position, okay? What is very interesting in this exact moment is this. Look, here we have the very top, 6 months before we started to see a divergence. S&P 500 was going up. The net positions for this category, the asset managers, started to go down. And what we have here is a divergence, because we have S&P 500 going up and the net position of the asset manager going down. What happened is history. At the very beginning of 2022, markets started to drop, and at the end of the summer, we had a very important low. Okay? Look what happened to the net position of this category, the asset manager, on this low. Here we had a lower low compared to the previous low on the S&P 500, but we do not have a new low, a lower low on the net position. It means they started at least not to short the market but they started to buy again the S&P 500. And the rest is history. Prices started to grow together with the net positions. Again, we can also cancel everything and we can have a better look here. You can see the divergence for the long run also here. You can see the blue line made a lower low, but not the net position that made a double low. Okay, here we have a divergence, exactly like on the tops, but of course the opposite. Okay, look what happened here. Here we had a top, okay, but look, 6 months before, the very top for the S&P 500, asset managers started to close the long positions. And what happened is history. We had very recently a very big crash, okay, an important crash, okay. Why? Me in particular, I was very bullish on this very important low. Many reasons, as you probably know if you follow this webinar. On that low, the undervaluation of the entire S&P 500 was very high. We were close to 20%. We were below the fair value at least 20%, which is something that tells us that the market is undervalued, okay? And we started to see a divergence between prices and the behavior of the asset managers. Because look, here we have a lower low for the S&P 500, but on the second peak, on the second low of the market, we can see they started to buy again. Okay, they started to buy again, and this is why. And of course, you can go to our YouTube channel and you can find the previous webinars. We said, guys, everything at the moment is telling us that the market can do a very nice rebound. Okay, so what we can learn right now from this position, okay? Harold is asking me, how does this relate to the overbought? Look, very simple. If you go to here, we add the important low here, okay? It was April, the beginning of April. If we go here and we go to April, we can definitely see, and this is why I was so optimistic for a rebound on the markets, we can definitely see that on the overbought and oversold page, we also had a very nice divergence with our indicator, the market mood meter, that was very low. Let me see. Okay, was very low and was indicating a potential important low in prices, like it did in August 2024 and like it did a few weeks ago. Okay, but let's go back to the COT report, because let me cancel everything. Let's go back to the asset manager. Let's put these here. Okay, so what we can learn right now from this chart, we can learn that we have to be very careful regarding this market right now, because look, Here we have a top, okay? Here we have a higher high compared to the previous one, but look, here we have a divergence because they, and I'm talking about the asset manager, they were very optimistic on the lows, but they are not so optimistic anymore because they are not pushing really hard on the gas, okay? Is it everything clear, guys? Do you understand what I'm telling you? Okay? Yes, perfect. Okay? As you can see, we have always to watch prices and the asset manager behavior, because if they behave like the price is doing, it means that the trend is safe, the trend is healthy. Okay, if they do something different, it means something can happen. Okay, for example, here you can definitely see that the market was dropping down, was stumbling compared to the previous low, but these guys started to buy. And when these guys are buying, it means that they put buy order on the market and the market rebound. At the moment, I'm not very happy because we are very close to a new all-time high, okay? But the level of volumes at the moment are not at the same level we had on the top, okay? So we have to be very careful. And of course, we have to watch week by week the new data because, of course, we can understand many things, okay? Anil, so potentially the S&P 500 can go drop again. Yes, guys, this is exactly what I'm telling you. Okay, we have to watch what is happening right now, because if we go to for example, overbought and oversold, very quickly we went back to an oversold, an overbought situation. As you can see, the market mood meter, which is something we created inspired by the fear and greed indicator from the CNN, is back to the overbought situation, is back on the FOMO area, and the FOMO area is an area where the market has potential to top out. Okay, so we have to be very, very careful, and we have to, of course, watch the data and understand if something in the behavior of the institutional investor is changing. Okay, we can see this kind of behavior also if we go back to the COT report list and we go to the NASDAQ 100 and we go to the asset managers. Look, we can see exactly the same behavior for the past. Okay, let's go here. For example, we can definitely see that um, the prices for the index were going up while the short position was the long position were closing down. Okay, here we had exactly the same divergence between prices and the net volumes. Okay, but here we do not have lot of, I mean, we can definitely see that the institutional investors are not pushing on the buy button like it should be with this kind of increase in price. Okay, this is something really amazing because at the moment we are very happy that we had a rebound back to the top, but the behavior of the asset manager is telling me that we could be in a danger situation. Okay, perfect. And this is regarding the indexes. Okay, we cannot use the COT report the same way on indexes and on commodities, for example. Okay, let me see if you have Edgar. Only today I managed to understand COT report. Thanks for great teaching, Luca. Thank you very much. I'm really happy. Try to imagine if my English was good and not bad as it is. Anyway, I always double check divergence if it fails because it shows how reliable this method is. July 2023 to July 2024, the managers had many negative divergence, but the market still climbed. So I have trouble trusting the divergence. So Earl, okay, I understand what you mean. This is not a timing tool. COT report is not a timing tool, especially for the asset managers, because asset managers are betting, let's say, for the long run. Okay, so they are not trying to timing the market, they just invest, okay, for the long run, but they decided to invest when they see the opportunity, fundamentally speaking. Okay, so for example, they decided to bet long both on the Nasdaq and the S&P 500. Okay, not because it was a good moment in terms of timing, but because few weeks ago the S&P 500, for example, was more than 20% undervalued. Okay, why they are not pushing more on the buy side? Why they are not buying a lot right now and they just like to stop to buy? Very simple, because if you go to the S&P 500 and you go to the fundamental layer of the forecaster, you can see that we are approaching the fair value. That's it. What happened is here to watch. We really went up very, very, very fast. Okay, so this is why at the moment they are not pushing hard on the gas. Okay, because fundamentally speaking, we are approaching the fair value. We do not have so much space. Talking about the hedge funds, so now for the indexes, we talked about the asset manager. If you would like to see what the hedge funds are doing, you have to watch non-commercial. These are the hedge funds. These and these are the hedge funds. Now let's move on, because of course, as you can see from this page, now we talked about the stock indexes, but we have many others, many others categories. We have the currency, the agriculture, and so on. Okay, something really interesting we can use when we go to the Forex. Okay, also in the case of Forex, we can definitely use the asset managers. These are the guys we have to watch if we would like really to understand what is going on the market. Okay, so for example, let's have a look to the euro USD, which is the most important uh, forex pair. Okay, and also here we have always to watch at divergency. Okay, when prices for the euro USD in this case and the volumes, the net volume goes together, no problem at all. The trend is healthy, the trend is safe, and we can go together with the trend. Okay, but look what happened when we start to see divergency. Here we have the euro USD, which is going up, and it made an higher high. But look what happened to the net positions. We have what we can definitely say it's a divergency. Okay, we have the net position that are going down while the price is going up. Very simple. And the rest is history. We have the euro USD, which is starting to go at the beginning down, and then we have a short, a bearish trend. Okay, as you can see, for example, in all this period, we do not have very big divergence between prices and the net volume, the net positions. Okay, we can find a divergence again here, exactly on this low. Look, here we have prices that are going down, and at least asset manager stopped to sell euro. Okay, sorry, stopped to sell USD. Okay, and they went back on track to buy euro. As you can see here, you can find a very nice divergence. Okay, as I told you, this is not a timing tool. For deciding the timing, you can use the overbought and oversold. Okay, you can use, look, for example, if we go back here to the asset manager, here we were at the beginning of 2025. Okay, because of course, remember, these data are weekly data, so we have just one data every week for every instrument. If you go here to the overbought and oversold, what you can find here is something really interesting, because look, at the very beginning of 2025, we had a very nice divergence between prices and our market mood meter. Okay, and if you go here to the Forecaster.biz website and you go to market mood meter, where is it? At the, here we are. You can see we use the euro USD as an example for a timing entry, for a long trade on the euro USD. Okay, but as always, we have to use the different layers for the forecaster in order to put the odds in our favor. What we can understand, for example, right now regarding the euro USD, here we have higher high on the price from July until now. Okay, but lower low on the orders. Lower low. Look, here we can see the trend, okay? We had an important low here. Here we have a trend, and here we have the same trend on the net positions, okay? So at the moment, this trend is safe, this trend is healthy. The only thing we have to look and we have to be careful at, here we have an higher high and here we have a lower high, okay? So for sure, we are on a bullish trend, but we have to be careful, okay? Because they are pushing with buy on the buy button, okay? We had an higher high compared to the previous high, but if they don't start to push again on the buy button, okay, this could be a bull trap, okay? Perfect. To think this is what you meant. Perfect. So we are aligned, okay? We saw exactly the same thing on the chart, okay? And that's it, guys. We have always to try to catch the big picture, okay? When we talk about the the asset managers positions, okay? Because remember, they are not here for doing scalping or very quick trading. They are here to invest for the long run, okay? That's it. Talking about FX, we can, of course, have a look to the non-commercials, okay? Very interesting. Remember, COT report is not something that give us always a clear signal, okay? It become very strong when we have a signal that is the same from non-commercial and asset managers, okay? For example, look, here we had the same divergence we saw on the asset manager. We can see the same divergence here for the non-commercials, okay? In the case of this important law, we saw the divergence on asset manager, but not here on the non-commercials, okay? So at the moment, we don't have a very interesting signal from the non-commercial on the Euro USD, okay? This is something really important. We have always to understand. COT report is not a timing tool, and sometimes it doesn't tell us nothing. It don't tell us nothing, okay? Something really interesting regarding the COT report is when we analyze the commodities, guys. This is something really interesting. We already talked about this matter few videos ago, but in the case of the commodities, what is very important is this category, the producer and merchant. Why? Very simple. These are the guys that extract the commodity we are talking about, okay? And so you have to understand that these guys, the producer and merchant and the processor, are not traders, okay? They just want to extract the commodity and sell the commodity to someone else, okay? Why they are here on the COT report? Why they use the future contracts? Very simple, because from the day where they extract the commodity until the day they sell the commodity on the market could pass something between 1 to 3 months, okay? In this period, if they go short with the future contract, they just freeze the price they have here. They extract the commodity, okay? And if they go short on this day and they stay short all the way long to the day they will sell the commodity, they don't risk nothing because they exactly know, thanks to this future contract, that they can earn the price they had the day they extracted the commodity, okay? Actually, this is exactly why the future market exists, okay? The future market allow producers to sell the commodity they are extracting today. The future market allow them to sell today something that they will sell in few months, okay? Is it clear, guys? This is exactly why the future market exists. Is it clear? Can you give me a feedback in the chat, please? Very clear. Perfect. Okay. So these guys know exactly, knows everything about the commodity they are producing, okay? And they know exactly how much does it cost to extract the commodity. They know how many order they have, okay? They know everything about the commodity because they are really the guys, they produce this commodity. So, for example, it's something very clear here on the natural gas. As you can see, they know everything about the commodity they are producing. So, as you can see, when prices are very high, they are very short, okay? Because they would like to have this kind of price for the next month. Look, when prices are very high, they have a very short net positions. Look, okay? And this is something interesting because, of course, we can understand if the producer think that the prices are too high, but if we do the opposite, we can also understand when prices are really low for a commodity, because they know everything about the commodity they are extracting and they are producing. And for example, look what happened in the past when they not only decided not to short the commodity and freeze the price, but look what happened when they decided to bet long. When these guys decided to bet long, a very important law always occurred on prices. And why I'm using the natural gas as an example? Because this is something that is happening right now. They are starting not to short the market in order to protect the price, but I imagine they think these prices are too low for the natural gas, and they are betting, okay, they are betting with the long position, with long trade on the future market, because probably they think the market will skyrocket again. Okay? So when you go on YouTube and you try to understand something about the COT report, everybody are talking about the non-commercials, and everybody are trying to copy what the so-called smart money are doing, but the real smart money are not the non-commercial, are not the hedge funds, but are the producers, if we talk about commodities, and are the asset manager if we talk about financial futures. Jacques, could we look at the gold? Of course, the gold, of course, is one of the most important futures you have on the market. You can find it here. And on the gold, we can go here, for example, on the producers, okay? And we can definitely see what I was talking about. If you draw a line and you see which in the past was the level, the, let's say, minimum level of the net position, you can definitely find all the moments where prices were on a very important low. Look, as I told you before, this is not a timing method, okay? This is not a timing method, but you can then find a better way to get inside the market when you understood the whole picture, okay? For example, at the moment, if we zoom in, we can definitely see that the producers thought that these were a very high price for the gold, but the gold started to rise again, okay? And they started to close a little bit the shorts, but at the moment, of course, we are very far to an important low that occur when the net position go close to the zero level. I stumbled upon Forecaster yesterday around 3 a.m. in the morning. It was an eye-opener for me. Thanks. Thank you very much. This is a very nice feedback from your side. Of course, what we have to search all the time is a divergence, guys, okay? What we have to search for is a divergence. But you have to understand the aim of the category you are watching, okay? For the asset manager, when we talk about the indexes, you know exactly that these guys are buying or selling, and they add positions if they see an opportunity for the long run. Remember, when we talk about commodities and we watch the producer and merchant, we have to understand that these guys are protecting themselves from prices volatility, okay? And so the only opportunity we can find is when they are betting long, okay? Try to guess a top because the producer are short is a mess, okay? This is not the way to use the COT report. Look, for example, if we watch the coffee, which is a commodity, as you can see, Very important lows occur when on average they have a very long net position, okay? Remember, producers are using futures in order to protect themselves, okay? They are not traders. Anyway, something really interesting, but we will talk again about COT report. Always try to find the divergence between prices and the net position of a specific category. And in my opinion, the best category to watch are the asset managers when we talk about index futures, and producers when we talk about commodity futures. Ali, corn future look good for a long. Let's have a look. COT report. Let's go to the agriculture. And here we are at corn. Let's go to producers. And let's always have a look to the past, at least 10 years, where you can understand what is happening. And yes, here we can definitely say that we are in a very good moment for a long, because look, here we had a spike in volume, the net position were net long. Here again, prices went down and they started to bet long. And look, now prices are exactly at the same level, more or less, we had in the past, okay? And we have a nice divergence here, look, between prices and the volume. This is very nice right now because look, we have a huge divergence. Prices are going down, but the net position are going up. This is a very nice moment for the corn, for example, because the producer are betting heavily long. Let's start with the last lesson of our masterclass. As I told you, today we will learn how to find opportunities, trading and investing on the market. If you lost the previous lessons, you can go here on Forecaster.biz and go here, tutorials, where you can find all the previous lessons. As you know already, probably, you can go on the Forecaster terminal and search directly for a specific instrument, a specific index, commodity, Forex, and everything directly from the search bar, as we do with Google. But exactly as we do in Google, we can also go here and on the right part of the page, up here in the page, you can find all the tools provided by Google. The same is for Forecaster. Here, up in the page, you can find all the tools, and especially if you would like to find opportunities, this is the way. If you're looking to be inspired by the forecaster, you have to search the opportunities going through all the tools, okay? The first one, the most direct tool you can use in order to have trading and investment idea is the quantum screener. This is something really interesting. It's something we also made some specific videos in the past. If you go back in our YouTube channel, you can find a specific video regarding the quantum screener. Here, investing like Jim Simons, quantitative trading real example, and Quant Screener Forecaster Terminal, new tool for gaining in the stock market. Here you can find these two videos on our YouTube channel. Anyway, the tool is very simple because it do something really simple at the end of the day, but we have so many data today to organize and to analyze that of course we cannot do without a tool like that one, like this one, okay? So very simple. How does it work? Very simple. You have to go here. You can search for a specific asset class, okay? So for example, if you are looking for indexes, very simple, you can choose indexes. If you would like to trade and investing on the S&P 500 stocks, you can go here on the S&P 500 and that's it, okay? Let's go for the indexes right now for me to be very clear on the explanation. So if you choose indexes and you choose the time frame you would like to trade, for example, let's do 3 months, and you can also choose if you would like to have to uh, to 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 have long or short or both the trades. Let's go, for example, only long at the moment. The system tell you which are the instruments that has the best correlation at the moment, okay? A combination of best correlation and the best win rate and the best average return. So, very simple. For example, at the moment, if we would like to trade indexes and we would like to trade for a period of 3 months, for example, and we would like only long trades, the Bovespa index, which is the Brazil index, is the best option at the moment because the actual price, okay, is correlated 80% with the 30-year seasonality, okay? With a winning rate of 60%, the average return for this trade is expected to be at least 10%, okay? If we open this specific instrument, as you can see, we go directly on the seasonality page and we have all the data, okay? So the system automatically select which is the most relevant seasonality because of its correlation. So at the moment, the current year, okay, so the actual price for the Bovespa index is 82% correlated with the 30 years seasonality, okay? It means that this index today, the current year, is moving like it did on average in the last 30 years, okay? It's something very simple. Of course, we can do it and we can find these opportunities because the system calculate for every indexes across the globe and give us the best opportunity at the moment, okay? We can, for example, switch, we can go to, I know many of you use the S&P 500 stocks, okay? Look, for example, with the same parameters, okay, so we just changed the asset class, we move to the stocks, okay, but we have 3 month and long trades. The first trade available is United Health Group Incorporated, which at the moment has an 87% correlation with the 3-year seasonality. What does it mean? If we open it, look, as you can see, the current year, the actual prices in pink are moving 86% like they did on average in the last 3 years. Okay? So here you have all the statistics. If the price right now are moving like they did in the past, okay, we can expect something like price it did in the last 3 years. So for example, in this specific period, which goes from tomorrow until the end of August, 3 months, of course, in the last 3 years, we had 100% of winning. It means we had a positive return in every year in the last 3 years, okay, with an average return on 9%, okay? As you can see, this is the return we had in 2024. This is the return we had in 2023. This is the return we had in 2022, starting from tomorrow, okay, until the end of August, okay? In this specific period, in this window, time window, okay? So, in this case, we can go directly to the chart and we can build our strategy. For example, what happened if, for example, I select this period and not starting from today? Look, we have a better result because we have 100% of return, but the average return increased. It's now 15% compared to 9, okay? So thanks to this tool, you can have many trading ideas on different asset classes, okay? And you can then select the best for you, okay? In this case, for example, you can now decide, for example, to wait a lower low, for example, on United Health. You can just wait, for example, for the specific date, which is the 18th of June, okay? You can just play the market as you would like to do. I mean, there is no a specific rule. For example, in my opinion, the best way to trade this market could be, for example, right now, since we have a very oversold stock at the moment, just to buy a portion of the entire position you would like to have, and then if the prices goes below the previous low, adding another portion, okay? But anyway, you can just trade as you prefer, as you like, okay? And what it's interesting is that thanks to the correlation, we have a specific idea of what we can expect from the future, okay? Because, for example, in this moment, we know that prices are moving like they did on this seasonality, the 3-year seasonality. So, for example, starting from today until the mid of June, let me check if we can be more precise, perfect. We can expect something like an average return for a short of 6%, okay? So in this case, thanks to the fact that current year actual prices are moving like the 3-year seasonality, we can just wait for another drop in prices and then start to buy, okay, this specific stock. What's important is that we found these opportunities thanks to the quantum screener, okay? And this is something we explain much better in these two videos where we present this new tool on the Forecaster terminal. Is exactly like is exactly what Jim Simons did in his entire life, treating stocks prices as mathematical signal. Okay, in this case we just use mathematics and statistics and correlation in order to find opportunities. We doesn't care who is United Health. We doesn't care what's behind a specific instrument, what's behind a specific company. Anil, which is the best correlation in terms of time? For example, about 3 years, 5 years, 10 years. Look, this is a very nice question because actually there is no a better time frame, okay? Because, for example, in this case, we know that the current year, so the actual prices, is moving like the 3 year seasonality. So we don't care. We don't care. It's just 3 years, okay? Because uh, this is just how the prices are moving right now. If they are moving like they did the last year, or if they are moving like they did on the average of the last 3 years, we really doesn't care, okay? Because they are just moving that way, and if we know that they are moving in this particular way, this is what we can expect from the future. Andreas is telling us, I normally sort it with win rate percentage, maybe over 8%, and win rate and correlation. Okay, yes, there is no a specific way you can use it, but for example, you can sort it, of course, for win rate, average return. You can sort it for best correlation. By default, we have the best to worst activated, which do an average of all these columns. Okay, but as I told you, there's no a right way to use it. You can, for example, look in this case, IQVIA Holdings is 97% correlated with the 1 year seasonality. It's in a very high correlation, very high. You can, of course, see also using your eyes that they are moving really, really similar. Okay. So, for example, in this case, this stock is moving like it did the last year. So, for example, in this case, what you can do, for example, if you just switch, if you select this period, as you can see, we have a more 8% of downside possibility, okay? A downside potential, okay? So for example, in this case, what I would like to do, what I prefer to do is just waiting another drop and then maybe trying to have this upside potential. As you can see, last year, in this specific period I just highlighted on the chart, this stock gained 18%. Okay, that's it. So you can start from the quantum screener. You can choose the time frame you would like to trade. You can choose the direction, long, short, on only long and short, and then the system give you, let's say, the best opportunities. Once you have the best opportunities, you can go deeper and you can use your strategy, your own trading strategy, your entry points, or you can use, for example, the overbought and oversold. I mean, the timing for the entry, it's up to you, okay? Andreas, is the quantum screener the best playlist to get the next good trade? If you are talking about trading, okay, and not investing, I really think quantum screener is one of the best screener you can have right now on the market, because this is pure statistics, and in the long run they are working. Okay, perfect. The something else you can use as inspiration for your investment idea in this case is the break even. This is again a very simple idea, but very difficult to do without a software that do it. Okay, in the break even page, as you can see, as always from the explanation, you can find the stocks that, after a series of at least 5 losing quarters, move to positive net income. Okay, examples of stocks whose stock market price began to rise immediately after reporting their first quarter in profit are many. Here are some examples. For example, I don't know if you remember Palantir, which is very famous today. These companies started to rise on the stock market exactly when they reported the first quarter in profit. Okay, we saw this pattern so many times during my 20 years in front of a PC investing. Okay, I was really young when I started, and I saw this recurring pattern many years. And then when I created the forecaster, this one of the first thing I asked to my developer: please give me a page and give me and put in this page only the companies that for the first time they have a quarter in profit. And for example, we talked a lot in the past about Twilio, which is in a very interesting company. Look, Twilio, you can find Twilio in this page for a very simple reason. The last quarter was a profit quarter for the company, and it was in profit for the first time. That's it. Okay. As you probably know, especially if you follow, let's say, my webinar since a while, if you go to any stocks on the market and you go, for example, here on the overview page, let's take Nvidia as an example, but it works for every company in the world. As you can see, prices follow the results of the company. Here in the overview page, we have the chart of the company on the stock compared with the net income. And as you can see, prices goes up when the net income goes up, prices goes down when the net income goes down. Okay? And this is why we have huge opportunities when the prices go very far from the net income line. At the same time, this is why we can find very interesting stocks when they turn in profit, okay? Because in the long run, companies start to rise in the stock market when they make money. And thanks to the forecaster, we know all the companies that for the first time, or at least after a series of 5 losing quarter, they go back to profit. And this is a very easy tool, very easy, but nowadays we have too many datas, and it's something we can, it's impossible to do with the software that do it automatically. Okay, Anil, how often the break-even page is updated? Immediately after the company announced the results of the break-even? Yes, exactly. Every time a company publish a new quarter, of course we receive it, okay? And if it match these characteristics, it goes directly in this page, okay? For example, at the beginning of the month, we add a new participant at the break-even page. I'm talking about Fossil Group. Okay, here we are. You can of course ask which is the business of this company to our Forecaster AI agent. Okay, and of course you can go deeper in the analysis. For example, in this case, look, I don't know nothing about Fossil Group at the moment, but I don't like, for example, these results because the sales are shrinking. Okay. Yes, we had for the first time a profit, but look, I mean, also the sales are really bad. So I don't like, for example, this company. Okay. Because the results are really strange. And then also the Z score is very bad. Okay. I don't like this company. I like, for example, Twilio. Twilio is a very nice company because look, the results are growing. Also, the net income is improving. Okay, they lost money in the last year, but they are improving their results, and this is the first time ever they have a profit quarter. Okay, if we go here, we can find, of course, we have to go deeper inside the analysis. And as you can see, for example, we can find a company which is solid with an Alt 1 Z score of more than 4. So the risk of bankruptcy is very low, very interesting. We have a company with a positive momentum also in the Piotrowski score. And we have a company which is not manipulating earnings. So I like this company. They just turned it in profit. This is why we cannot rely on the fair value because it's very difficult to calculate a proper fair value with a company that lost money since ever. Okay, but we can go deeper. We can analyze the business. We can analyze everything thanks also to the AI forecaster agent. Okay, we can remember to go here and have a look to the transcription of the quarters, because here you can find the positive news, but especially you can find the negative news and the risk and concern. Okay, we have always to analyze the risk and concern. Remember, you have the raw part, the raw results, and here you can ask the artificial intelligence to analyze the data, okay? Both annual and quarterly, very interesting. Balance sheet and cash flow, you have everything. But what is more important right now at the moment, this company is starting to do buybacks. Look, they started at the end of 2024 to do buybacks, and this is something really amazing because, as I explained when I talked in the stocks lesson, you can find on our tutorial page here stocks stocks investing here, the second lesson, you can find a more in-depth analysis of the buybacks, this is very interesting. So for example, this is a very nice company and we bought it, okay, because for the first time ever, they turn in profit, okay? The company is nice, the business is nice. I mean, this is how we use the break-even section, which is very, very nice, okay? Another section I really use is the macro map. The macro map is very interesting because we can see which are the most interesting sectors in a specific moment. As you can see here, you can find the statistics. So you can find, for example, in which phase of the economic cycle a specific sector is, okay? And also you can find the price change. So you can see, for example, how specific sectors are moving, and you can, for example, see how a specific sector did in the last week, how a specific sector did in the last month, in the last 6 months, and so on, okay? Thanks to this tool, you can see, for example, that the energy sector and the healthcare are in what we can call a recession, okay? You can find, for example, that materials, consumer cyclical, information technology, industrial, utilities, and financial are now in an expansion moment, okay? What you can do is very simple, because if you are interested in a specific sector, you can go directly here where you can find all the stocks, all the companies inside this sector, okay? And you can rank them with the best to worst. For example, you can find which are the most underrated company. You can go and have a look to the most important ratios. For example, you would like to see which is the company with the highest dividend yield in the communication service sector. Here you are. You can find it with just one click. And of course, you can also go here and find which are the best performer, which are the worst performers. So for example, you would like to see which are the best performer in this specific sector in the last month. Perfect. Here in a click, you would like to see which are the worst performer. You can go and have 2 clicks and you can find all the data here. Okay, very simple. Okay, what is very interesting is that, for example, now we are in an expansion um, phase, for example, on basic materials. Okay, but at the moment we have a bad correlation. Look at consumer cyclical. We are in expansion, and we also have a very high correlation with the seasonality. So we can go here and we can see exactly, sorry, we can go here. If you click this button, you can find the chart of the S&P 500 sector index. This is exactly the consumer discretionary sector put on chart. And as you can see, for example, you can highlight a specific period on the, for example, last year, which is the year with the highest correlation, okay? And you can see what we can expect. As you can see, you can go directly on the macro map and you can be inspired by um, by a specific sector. For example, you know that consumer cyclical is on ramp, is in expansion, okay? So, for example, it's a good moment for going in the specific sector, okay, we said consumer cyclical, you can go here and try to find opportunities, for example, thanks to the momentum. So you can rate, for example, which are the best company in the last week and the last month, and you can go and trade them because the entire sector is in a positive momentum, as you can see here on the macro map. So momentum is one of the best strategy if you know how to handle it, okay? You have many ways to use the forecaster terminal, and starting from the macro map is a very interesting method to find opportunities. Okay, of course, the last tool I would like to show you is the rankings. Of course, as I told you, here you can find indexes, you can find the sectors, and you can find industries, because every sector, we have 11 sector in the S&P 500, are divided also in industries, okay? So you can really deep dive and find something really interesting regarding a specific sector.